Good morning, all our PFMA stakeholders. I am Elisa van der Westhuizen, the Head of Technical at the Accounting Standards Board. I am joined today by our lovely team of ladies who I will give a chance to introduce themselves in just a moment. A very welcome to you all to our annual GRAP update. I think this is the third year that we are hosting a GRAP update ourselves as the Accounting Standards Board, and it has been a pleasure to see it grow and to get your positive feedback over the years. I think it has certainly become a highlight on our annual calendar. We believe we have a key role to play in supporting entities to prepare quality financial statements, and the content that we have put together for today's discussion has that purpose in mind, and we certainly hope that you will find it useful. As we're always looking to improve, we appreciate your feedback afterwards. Please send us an email if there's anything that you would like to share with us to help us improve. With that, I'm going to hand over to the ladies of the ASB to introduce themselves to you quickly, and then we will get on to some administrative arrangements for the day. I do see a hand. Let me just first go to Lawrence. Please go ahead, Lawrence. Okay.
Yes, good morning. Good morning. Can you hear me?
Yes.
Thank you. Good morning. I just want to find out, is it possible that at the end of the session, maybe we can share the recordings of the presentation?
Yes,
for some of our colleagues who couldn't make it to be part of this presentation.
Yes, I will get to that in just a moment when we talk about the admin. Definitely, there will be a recording.
Thanks a lot then.
Perfect. Please go ahead, Amanda.
Listener, good morning to everyone. I'm looking forward to today's discussion and looking forward to your questions. So welcome from my side. I'm Amanda Puerto. I'm a standard setter at the ASB. Thanks, listener.
Morning, Amanda. Amanda continues the theme of the month of love in a beautiful red this morning. Janine, please go ahead.
Good morning, everyone. Janine Poggiolini, I'm the CEO of the ASB. I won't join you for the whole session today, but certainly wanted to echo your listeners' comments. It is really a highlight on our calendar, and was blown away yesterday to see that we were going to have about 600 people today. So really thank you to you for spreading the word to your colleagues, for joining us today. I think we have this realization that we can't just issue the standards. We do have a greater role to play in making sure that you understand what it is that we have issued and how it should be applied, and overall trying to improve the quality of the financial statements that we see. So thank you for joining us today. I do hope you find the session useful, and you are in very capable hands with the listener and Amanda, CEO, and Nabila. Thank you very much.
Thank you, Janine. Nabila?
Good morning, everyone. I am Nabila Imam Shah, standard setter at the ASB. Welcome to one and all to today's discussion. I understand that you are joining us from all parts of South Africa. It is a very dull day today in Johannesburg, but hopefully it will brighten up by tomorrow at least, so we can effortlessly host the SA20 cricket finals.
Thanks, Nabila. Sia, please go ahead.
Thanks, Elizna. Good morning, everyone. I think this is the biggest number we've managed to pull over the years, and we're excited for this session. We're looking forward to everyone's engagement. I'm one of the standard setters at the ASB, and I think I missed the memo today, Elizna. There's no bit of red, but I think I tried. I'm close with the pink, so it's not a train smash. I'm looking forward to the session. Thanks.
Great. Thank you very much. Thanks, ladies. Then just a bit of administrative arrangements before we kick off today's discussion. I do just want to clarify that it is not training that we are presenting to you today. It is an information sharing session. So there will not be any certificates afterwards that we can provide to you or confirmation of attendance. Unfortunately, we cannot do that for today's session. We have set this up as a webinar given the volume of attendees. So what that means is that you are unable to use your camera or your microphones. However, we do want you to participate in the discussion. You are welcome to raise your hand, and at that point we can unmute you and allow you to contribute. This way it just minimizes any unwanted disturbances and we can keep everyone focused. Then I think you are also very welcome to use the chat, and we have also enabled the Q&A function for today's discussion. Please use both of those as you wish, and we as the ladies of the ASB will continue to monitor both those platforms, the chat and the Q&A. Then we do have the slides that I'm flighting at the moment available on our website. If you would like to look at them in your own time or follow on your own screen, you are welcome to download them from our website. I will post the link in the chat just now when we start, and then please go and grab them there if you want. We are going to make a recording of today's GRAP update available on our YouTube channel. If you are not already following us on YouTube, then please go and subscribe to our channel. That is another link that I can share with you on the chat just now when we start. We should be able to have that on the channel by mid next week. So I think you can look out for the recording around Wednesday. Then I think just a brief introduction of the agenda today. We are going to start by giving you some information about the reporting landscape for this year, 24-25, and also a peek into what's coming. Amanda will take you through that. One of the key things on our agenda for this next while is financial instruments, which has been revised, GRAP 104, and it is effective from 1 April 2025. We do want to ensure that all stakeholders are prepared and able to apply these requirements. 1 April, as you know, is around the corner. And you already need some information for retrospective accounting for that. So that is going to be a session that Nabila will take you through. Then this time of the year, it's important for us to help make sure that you have all the tools that you need to prepare quality financials. I think Janine and I both alluded to that as something we see ourselves supporting you in. And Sia is going to take you through a presentation on that. We will take a quick comfort break at that point, and after the comfort break, I will share with you one of the exposure drafts that we have out for comment at the moment. This is a key exposure draft where we are sharing and giving you an opportunity as our stakeholders to contribute to our next work program. And we want to hear from you, what are the projects that you think we should do? What do you struggle with? So that is going to be after the break. Then we will end on a bit of a lighter note at the end of the day. We will tell you about the exposure drafts that are available for comment at the moment. We will tell you about a recently issued guidance from our side. And then lastly, we have a project where we try and enhance how you apply the standards of GRAP. And we have different ways of doing that with content that we publish on different platforms. So we will be speaking to you about that at the end of today. So I think then without further ado, I'm going to hand over to Amanda, who will start us off with the first topic.
Thank you very much. Right, so I'm going to start with the GRAP reporting framework. Ilesna, just to confirm, everybody can hear me?
That's right, Amanda. Okay.
Thank you. All right. So I'm going to start off with the GRAP reporting framework. I see there's a hand. Delani, go ahead, please.
I think it was a hand to just confirm that they can hear you, Amanda.
Okay, all right, thanks. Okay, let me start. So I'm going to take you through the GRAP reporting framework for 2024 and 2025, but it's also important to note what you can expect from next year that you need to comply with by the end of March 2026, because in terms of the standards of GRAP, you need to understand the impact of that and provide some disclosures around that. So for this year, ending 31st of March 2025, there are no new standards of GRAP, including any interpretations that's effective. So whatever you've been doing in the past, that status quo remains. Looking forward, there are a number of, there's two pronouncements actually, that's becoming effective from the 1st of April 2025. As the listeners indicated earlier, Nabila will take you through GRAP 104 on financial instruments. That is one of our big projects for the year. The other interpretation that's becoming effective is IGRAP 22 on foreign currency transactions and advanced considerations. Now, this interpretation specifically speaks to the requirements in GRAP 4 on the effects of changes in foreign exchange rates. And really what GRAP 4 requires is for an entity to record a foreign currency transaction on initial recognition in its functional currency by applying an exchange rate at the date of the transaction. But in some instances, an entity may receive an advance or may pay an advance. And as a result, the question arose as around what is the date of the transaction that we need to apply when we recognize a non-monetary liability that arises from the receipt of an advance consideration before you recognize the related revenue, expense, or asset. So this interpretation then concludes that the date of the transaction for purposes of determining the exchange rate is the date on initial recognition of the related asset. So that is on the date that you have received the advance consideration or when you have paid the advance consideration. So that will then be the exchange rate that you need to use in order to account for the specific transaction. Then on the other side, and I'm going to go through each of these, are improvements to the standards of GRAP. We have some amendments to GRAP 1 on the presentation of financial statements concerning the going concern. We have revised GRAP 103. That was following the post-implementation review that we undertook a number of years back. And then also amendments to GRAP 105 on transfers of functions between entities under common control. GRAP 106, transfer functions between entities not under common control, and then mergers GRAP 107. Important to note that the 4 that you see there on the right-hand side, you can't early adopt any of those. Those need, and the Minister of Finance first need to determine an effective date for these pronouncements or amendments, and hence you are only allowed to early adopt them once the minister have determined an effective date. So for the time being now, they are very important to note, but for this year and then for 25-26, it doesn't have an effect on your financial statements. So I've talked about IGRAP 22 on foreign currency transactions. For this one, because it is effective from the 1st of April 2025, you may early adopt the interpretation, but you need to adopt the interpretation in full. GRAP 104 on financial instruments, that is replacing the old GRAP 104 that entities are currently applying. That's also effective from the 1st of April 2025. You can early adopt the standard as well, but you need to adopt the standard in its entirety. So Nabila will take us through GRAP 104 and highlight to you some of the amendments and changes there. So let's have a look at the other standards, and remember again to highlight that you cannot early adopt these because the Minister of Finance has not yet determined an effective date for them, but still it is important for you to be aware of these changes and what can become effective once the Minister determines the effective date. So the first one is around the presentation of financial statements concerning the going concern guidance. So the amendments that was made to GRAP 1 was to better explain when it is appropriate to prepare financial statements on a going concern basis in the public sector, as well as the inclusion of additional disclosure requirements. So the amendments or the revisions to GRAP 1 was really to clarify that it is inappropriate to prepare your financial statements on a going concern basis when there is a decision taken to liquidate the entity, to cease its operations in its entirety, or when there is no realistic alternative to do so. The interpretation then also clarifies that, or the amendments to GRAP 1, pardon me, also clarifies that where some or all of the entity's functions are transferred in a transfer of function or a merger, the functions previously provided by that entity will continue to be provided just in another form. And therefore, it remains appropriate for the entity to continue to prepare its financial statements on a going concern basis. The amendments to GRAP 1 also clarified that if there is a transfer of functions and the remaining functions are discontinued, these are two separate transactions that you need to consider and for purposes of whether or not the going concern is still appropriate or not. Then around the disclosure requirements, the additional disclosure requirements that was included in GRAP 1 is really to understand or to provide more information to the users of the financial statements when there are one or more uncertainties that might cast doubt on the entity's ability to continue as a going concern. So some of these disclosure requirements that are included is, first of all, it requires GRAP 1 now requires you to disclose the fact that there are one or more uncertainties that might cause significant doubt on the entity's ability to continue as a going concern. There's also disclosures required around principal events or conditions that gave rise to these uncertainties, the effect of these uncertainties on current and future reporting periods, and lastly, the information about management's plans and actions to address these uncertainties and to mitigate the effect of these uncertainties on the entity's operations. So again, GRAP 1, the amendments may not be early adopted because the Minister of Finance has not yet determined the effective dates for these. The next standard for which we are still waiting approval from the Minister is GRAP 103 on heritage assets. So for this one specifically, there was a number of changes following the post-implementation review that was undertaken by the board. So the first amendment, and I'm not going to highlight all of these to you, but just touching on a few of them, is for the definition of a heritage asset that was amended to better align with the explanation of a heritage resource in the National Heritage Resource Act and in the SARA classification. So what that means is that the definition now brings in the concept of cultural significance. And cultural significance is defined. It's aligned with what we have in the SARA classification and the National Heritage Resources Act. So for entities to better understand when an item meets a definition of a heritage asset. The next amendment that was made in GRAP 103 is around the classification of dual-purpose heritage assets. So in terms of the current requirements that we have in GRAP 103, it requires an entity to assess whether the heritage asset has a dual purpose. If it does so, it needs to assess what is the significant portion of the heritage asset used for. So is it used, for example, as property, plant and equipment? And then you are required to classify that heritage assets as property, plant and equipment and apply GRAP 17, pardon me, to that standard. So the amendment that was made is to say, irrespective of whether a heritage asset has a dual purpose, you need to account for that in terms of GRAP 103. So you now no longer need to determine what is the significant use for the assets, and based on that classified, all heritage assets are to be accounted for in terms of GRAP 103, which obviously means that heritage assets are not depreciated. So there are some transitional arrangements around that. The next area where the amendment was made to GRAP 103 was around determining a reliable value. So in terms of that, the guidance in the standard indicates that you can now use peer group data. So you look at a comparable heritage asset held by another entity if you are not able to determine a reliable value, and you make use of that comparable information to determine a value for your heritage asset in bringing it onto your statement of financial position. Then there's also requirements around the reassessment if a reliable value becomes available. So in terms of the current requirements in GRAP 103, if you can't determine a reliable value for a heritage asset on the date of adoption or of acquisition of the asset, the heritage asset, then the standard allows you to not recognize it, but to present some information around the fact that you do have a heritage asset, but you are not able to determine a reliable value for that heritage asset. So the amendment that was brought into GRAP 103 was really to say that on an annual basis, you need to reassess if information becomes available to enable you to recognize that heritage asset. And if so, you need to bring on the heritage asset on your statement of financial position from the date that you are able to determine a reliable value for that asset. The adjustments that you need to make is going to go against your surplus and deficit. So that is one of the new requirements within GRAP 103. Then also some of the encouraged disclosure requirements were deleted based on the engagements that we had with stakeholders during the post-implementation review. But the disclosure around heritage assets borrowed from and on loan to other entities have now become a mandatory requirement. Again, for GRAP 103, you may not early adopt these changes because the Minister of Finance still needs to determine an effective date. Then improvements to the standards of GRAP. So improvements to the standards of GRAP are minor, non-urgent changes. It doesn't change any of the principles within the standards of GRAP, and the board undertakes an improvements project every 3 years. So again, for this, you can't early adopt that because the minister still needs to determine an effective date for those. So some of the changes was, for example, to include additional illustrative examples. An example of that is the illustrative example that's included in GRAP 5 on borrowing costs. Another example is around a clarification that has been provided around presentation of on the standard on presentation of budget information on public availability and public accountability. So those two concepts have been clarified, both in GRAP 1 on presentation of financial statements and then in GRAP 24 on presentation of budget information in the financial statements. Then there are a number of encouraged disclosure requirements that were also removed as part of this improvements project. The next area is the amendments to GRAP 105, 106, and 107 on transfers of functions and mergers. And the objective of these amendments was really to align with the principles in GRAP 104, IPSAS 40 on public sector combinations, and to include the new requirements in IFRS 3 on business combinations. So the amendments include both revisions that's incorporated from IPSAS 40 and IFRS 3. So on IFRS 3, some of the new guidance that was included is really to assist an entity to assess whether the definition of a function has been met. From that perspective, guidance around an optional or concentration test has been included, and this guidance will help you to assess if a transfer set of activities, assets, and liabilities is not a function. If you apply this test, you can decide to apply the test or not. But if you decide to apply the test, and you conclude that the transferred set of activities, assets, and liabilities is not a function, it then means that you're outside the scope of GRAP 105 and GRAP 106, and you need to account for the assets and the liabilities that you've acquired or assumed in terms of the applicable standards of GRAP. Then the other guidance on IFRS 3 was really to assess if a transferred set of activities, assets, and liabilities does not have output, if that is substantial. Again, if it is not substantial, you will fall outside the scope of GRAP 105 and 106, and you will have to account for the transferred activities, the assets and liabilities in terms of the applicable standard of GRAP. The next area of guidance that we've included in GRAP 105 was the guidance from IPSAS 40. And that is really, first of all, to better align with what we have in the public sector. But to note that IPSAS 40 is a single standard that deals with public sector combinations and IFRS with business combinations. So one of the decisions that the board has taken here was to retain the three separate standards of GRAP. So you still have GRAP 105, 106, and 107 with the amendments that was included from IFRS 3 and IPSAS 40 into the three different standards then. So first of all, some of the scope exclusions have been added to 105, 106, and 107, and also the scope exclusions across the three standards of GRAP was better aligned. There was also new definitions for acquirer, transferor, acquiree, also for a function. And again, that is just to better align with what we have in IPSAS 40 and within IFRS 3. Then there was also some additional examples of how control is obtained in a non-exchange transaction, guidance on measuring non-controlling interest in the acquiree, and then also some additional illustrative examples to explain, for example, the disclosure requirements that you need to provide under GRAP 105, 106, or 107, or then also the measurement period that allows you 2 years to measure the assets and liabilities in a transfer of function that you have acquired or then in a merger. So compared to IPSAS 40, some of the areas that the board has not included in the local standards is first of all around the treatment of goodwill. So in terms of IPSAS 40 and IFRS 3, entities are required to recognize goodwill, which is the excess of the consideration paid over the fair value of the assets acquired and the liabilities assumed and any non-controlling interest. So in terms of IPSAS 40 and IFRS 3, you need to recognize the goodwill, and the goodwill is then subject to an annual impairment test. Currently, GRAP 105, 106, and 107 requires us to recognize the excess of the consideration paid over the fair value of the assets, liabilities, and the non-controlling interest in surplus and deficit, and the board has agreed to retain that requirement. So no recognition of goodwill as in the private sector and then from the IPSAS B's perspective. Another area is around the measurement period. So for this one, IPSAS 40 and IFRS 3, or IPSAS 40, pardon me, allows 1 year for the measurement period, which means that you have 1 year from the acquisition date to recognize your assets, liabilities, and any non-controlling interests. The board agreed to retain the 2-year period for the recognition measurement of the assets and liabilities, and that is really just based on local circumstances where we need more time in order to make sure that we bring onto the statement of financial position all the assets and liabilities at the values, at the correct values. Right, I did see a hand, just maybe to check if there's a question. All right, so I'm quickly going to touch on the IFRS standards that you are not required to apply. So the information that I'm going to present is what the board has agreed in the reporting framework in September 2024. So on an annual basis, the board issues an annexure to Directive 5 that really sets out the standards of GRAP, IFRS standards, IPSAS standards that you might consider, which you might not consider when you prepare your financial statements. So from that perspective, the IFRS standards that might not be applied is first of all IFRS 13 that deals with the measurement. So from a public sector perspective, the IPSAS B has issued IPSAS 46 on measurement that has an effective date of 1 January 2025. So what the measurement IPSAS is about, it's really a single standard that addresses how commonly used measurement bases needs to be applied in practice. Some of you may have heard of the current operational value. We talk about fair value. So those are some of the measurement bases. And this standard really explains to you how you commonly need those commonly used measurement bases, how you need to apply them in practice. So from that perspective, the board is considering a project, a similar project, developing an exposure draft. And that is included on our work program. We have already commenced work in this area. So you need to, you can keep a lookout for any exposure drafts and any developments in this regard. Then regularity deferral accounts, IFRS 14. So in the public sector, there is no equivalent standard for that. The standard only applies to first-time adopters of IFRS accounting standards. And the board has assessed that locally, the standard is not applicable to entities that apply the standards of GRAP. And hence, there's no need for entities to consider that when they prepare their financial statements. The next IFRS or IPSAS that cannot be applied is around revenue from contracts with customers, IFRS 15. The IPSAS B has issued IPSAS 47 on revenue that has an effective date of 1 January 2026. So the revenue standard really replaces in the public sector, the free revenue standards on construction contracts, revenue from exchange transactions, and revenue from non-exchange transactions, taxes, and transfer. The standard, the IPSAS provides guidance around distinguishing revenue transactions with or without a binding arrangement. So in terms of that, the board has included this as a project on its work program. So we have commenced with the development of guidance in this area. We will starting towards this year. Well, in this year, you will commence with some work on that. So in the meanwhile, because you are not allowed to consider IPSAS 47 or IFRS 15, you will have to continue to apply the standards on revenue locally, which is GRAP 9 on revenue from exchange transactions, GRAP 11 on construction contracts, and then GRAP 23 on revenue from non-exchange transactions, taxes, and transfers. Then on the leases standard, IFRS 16, from an IPSAS B's perspective, they have issued IPSAS 43 on leases, which has an effective date of 1 January 2025. So the leases is really a new standard that introduces a right of use model for lessees to replace the risk and rewards model that we have in IPSAS 13. There's also public sector guidance around concessionary leases and other arrangements that conveys the right over assets. So from our local perspective, the board will consider this to be a project after 2026, and that we are currently consulting on as part of our work program for 2027 to 2029. So Elizna will touch on that during her discussion of ED 211. So for the time being, entities continue to apply GRAP 13 on leases. Then on insurance, IFRS 17, there's no IPSAS equivalent for that. So in terms of the reporting framework, the board undertook an assessment to see whether IFRS 17 is applicable within our local circumstances. So as part of the GRAP reporting framework ending 2025, so the 31st of March, IFRS 17 cannot be considered by entities when they account for that. It has, however, been included in the reporting framework from 2025 to 2026 after the board has completed its review around the applicability of IFRS 17 to the local circumstance.
Apologies for the connection problem, members. Maybe just give Amanda a moment or two to rejoin. The issue does seem to be on her side. It is not on your side. We will just give her a moment to see if it comes right. Otherwise, one of us will continue while she rejoins. Okay, thank you. I see all the thumbs up. Apologies for this, members. I am just going to attempt to take control, and then we will resume in a moment. I think let me just share from my side. Apologies for the delay. We will resume in just a moment. I think you should now see my slides. So I'm just going to pick up where Amanda left off, explaining the application of IFRS 17 and IFRS 16.
Elizna, I can see slide 11.
Okay, great. Thank you very much. So apologies if I'm repeating what she had said. I think let me just start at the top of this slide again. So these IFRS standards entities should not be applying because we do have either an international public sector project ongoing for that we will pick up once the international public sector project is concluded, or in other instances, we already have local projects going on. So in the leases space, I think Amanda may have mentioned that we are going to consider picking this up as part of our next work program. But I think the important thing is, even though there has been international development in the private sector, IFRS 16 is up and running, and in the public sector, IPSAS 43 on leases has been published by the IPSAS-B. It is effective this year. There is no change to the standards of GRAP as of yet. You continue to apply GRAP 13. So when I speak to you about our work program in a later discussion today, then you can let me know if you think we should pick up leases in our next work program. That is then a possibility for us to do if you think this is important. On insurance, we do not have many entities, in fact, only one that we know of in our environment, who provide pure insurance and would be in the scope of the insurance standard. There's no equivalent IPSAS standard, and for our local requirements, we have in Directive 5 that determines the GRAP reporting framework, currently IFRS 4, which means that if entities do have these activities, they can develop accounting policies with reference to IFRS 4 for them to be able to account for their transactions. From next year, the board included IFRS 17 in the the GRAP reporting framework as part of those pronouncements that entities may consider to develop policies. So for 24-25, there's no change. For 25-26 entities, and I should say again, only really that one entity may start to use IFRS 17 to develop its policies. So for most of you, it has no impact. Latest.
Sorry, I am back if you want me to continue, but you can also continue if you
okay. Perfect. Let me hand over to you. Thanks, Amanda.
Okay, sorry for the network connections. I must say that we've been having some connection trouble this last week. All right, so I'm going to switch off my camera just for purposes of making sure that the connection is stable. So the next area that we cannot apply is around the presentation and disclosure of financial statements, IFRS 18. So from that perspective, the ASB has issued the standard to improve the presentation of financial statements, and it really introduces 3 categories for income and expenses, being operating, financing, and investing. The IPSAS-B has commenced work on development an IPSAS in this area. And then from ASB's perspective, we will consider this project as part of the 2027 to 2029 work program. So again, Elisna will talk to you about that and whether you think that we should take that up as part of our work for the period 2027 to 2029. Then subsidiaries without public accountability disclosures. All right, yes, okay, sorry. So yes, we're on slide 12. So the second one there is around subsidiaries without public accountability disclosures. So this IFRS allows subsidiaries to reduce the disclosures in their financial statements, but it can only be applied by those entities that don't have public accountability and whose parents or holding companies use IFRS standards in their consolidated financial statements. The IPSAS has not yet considered that, so there's no equivalent IPSAS for that. We've concluded that the standard is not applicable because from a South African perspective, all entities are publicly accountable, and therefore entities may not consider that when they prepare their financial statements. Right, so then the next slide is the amendment to IPSAS 19 for collective and individual services. So that is on the ASB's work program for 2024 to 2026. Employee benefits, we have already considered the requirements in IPSAS 39 and have revised GRAP 25, which is effective. And so entities are required to apply GRAP 25 on employee benefits.
Sorry, Amanda?
Yes?
Sorry, just so you don't go too far, I think there's a hand from Onke. You might want to take that hand before you move on.
Okay, sorry about that. Please go ahead. Okay.
Apologies, members, when you raise your hand, we just need to allow you access to your microphone. So we are just going to do that for you, Anki, and it's going to take a moment or two before it's effective. Just try now to unmute. I think you should be able to unmute now. Please try. Yes, there we go. You are muted again, Anki. Just unmute again. There we go.
I'm going to continue. Perhaps, Anki, you can include your comment or your question in the chat box so that we can have a look at that. So on employee benefits, we have already considered the amendments in GRAP 25 on employee benefits, which was revised and it's already effective. So entities need to apply GRAP 25 on employee benefits. On public sector combinations, IPSAS 40, I've talked about that. So I've indicated that we have revised GRAP 105, 106, and 107 on transfers of functions and mergers. So in terms of that, the standards have already been revised, but we are still waiting for the Minister of Finance to approve the effective date of those amendments. Financial instruments, entities are required to apply GRAP 104, with the new GRAP 104 becoming effective on the 1st of April 2025. On social benefits, so we are locally in the process of developing a social benefit standard. It's almost, it's going to be considered by the board in March to be approved as a final standard. So entities just need to wait for that, to retain the current accounting policies, because this project is currently underway from the board's perspective. Okay, then the next slide. On non-current assets held for sale and discontinued operations. So in terms of that, the IPSAs have adopted the IFRS standard. Locally, we have developed GRAP 100 that only deals with discontinued operations. There are some requirements in GRAP 1 around when you want to have non-current assets held for sale, so you need to comply with those disclosure requirements. Then on property, plant and equipment, the revised IPSAS 17, which is now IPSAS 45. So they have included some additional guidance in IPSAS 17 around infrastructure, which is now explaining how you need to apply the principles in IPSAS 45 on property, plant and equipment to infrastructure assets, likewise to heritage assets, and then also they've included some guidance around measurement considerations. So from that perspective, the measurement guidance will be considered as part of the ASB's measurement project. Infrastructure guidance that I've included, we will consider as part of our next improvements project. And then the heritage assets, entities are required to apply GRAP 103 on heritage assets in accounting for the heritage assets. Then on transfers expenses, IPSAS 48. So transfers expenses, this standard really deals with expenses that arises from a transaction other than a tax, where the entity provides goods and services or an asset to another entity without directly receiving a good or service or asset in return. So this is also a project that is currently included on our work program, and we will commence work on this project towards the end of the year. Retirement benefit plans, IPSAS 49 and 50 are two of the newest standards that has been approved by the IPSAS B. So on retirement benefit plans, the standard really explains the accounting and the reporting requirements for public sector retirement fund plan, or retirement benefit plans, pardon me. Information needs to be presented around the plan's activities, assets, and its obligations. So the board did not determine that IPSAS 49 is applicable in our local environment, so we will not be commencing on a project in this area. The last one is IPSAS 50 on the exploration for and evaluation of mineral resources, which was really based on IFRS 6, the exploration for and evaluation of mineral resources. And that IFRS is included in the reporting framework, so entities might consider that to the extent that is applicable. The IPSAS really provides guidance around the exploration and evaluation of mineral resources, including the measurement, the presentation and disclosure requirements, as well as accounting for the benefits that may arise when the waste removal activity of a surface mine is accounted for. So that really, in short, is an update on the GRAP reporting framework, what you can expect as from the 1st of April 2025, as well as the other pronouncements that was issued by the board, but for which we are awaiting Minister's approval. So with that, I'm handing over to Nabila. I'm just checking to see if there are any questions or comments in the chat, and then I'll respond to that during Nabila's presentation. Thanks, Nabila.
Thank you, Amanda. Okay, everyone, let's carry on to our next topic. We are discussing now GRAP 104 on financial instruments. Okay, so if there's anything that we would like to emphasize today is to ask you if you are ready for the revised GRAP 104. The effective date is 1 April 2025. This means that for the financial statements you are preparing during this year, it will be the last year that you are applying the old GRAP 104. So what we are posing to you is we are asking firstly whether you are GRAP 104 fit. What do we mean by this? Do you understand the new requirements in the revised GRAP 104? And are you familiar with how the changes will affect your entity? Now, entities need to understand where and how to obtain the information they need to apply the revised standards. This will most likely result in changes in an entity's processes and systems. Entities need to gather historical data for retrospective application of GRAP 104. Now, we have often seen in entities' financial statements where they try to disclose the effect of standards issued, not yet effective, and they note that the effect is immaterial. I want entities to carefully consider this. If you look at GRAP 104, which applies to financial instruments, it is likely applicable to most entities because most entities have a bank account. So please, everyone, if you have not done this exercise yet, it is late, but you can make up. So please start with this, gather historical information for retrospective application so that when you prepare financial statements next year, you are ready and you understand and can apply the revised GRAP 104. Okay, let's look at the key changes in the revised GRAP 104. Now, amendments to GRAP 104 were approved in 2019, and these changes were made to align with international standards. So why the change? Changes in IFRS 9 and IPSAS 41 were made to address the shortcomings in the classification and measurement of financial instruments that were highlighted during the financial crisis. The most significant changes in GRAP 104 relates firstly to the scope, where financial guarantee contracts and some loan commitments are now in the scope of GRAP 104. Previously, they were in GRAP 19. When I do refer to previously in my presentation or old GRAP 104, please note that I am referring to the current requirements. There are changes to classification as well. Here, there still is the same number of categories, but the classification principles have substantially changed. And lastly, there is a change to subsequent measurement with respect to the impairment model. Okay, let's unpack each of these key changes. Key changes to the scope. Financial guarantee contracts and loan commitments are now in the revised GRAP 104 and not in GRAP 19 on provisions. Looking firstly at financial guarantee contracts. What is a financial guarantee contract? This is a contract that requires the issuer to make specified payments to reimburse the holder for a loss it incurs because a specified debtor fails to make a payment in accordance with the terms of the debt instrument. The arrangement must firstly be contractual, and secondly, it must guarantee a specific debt arrangement between a lender and a borrower. If we look at government's obligations as a lender of last resort, example where government is obliged by legislation to guarantee the debts of entities or activities, these are not financial guarantee contracts. This is because the arrangement is not contractual and there is no specific debt being guaranteed. Letters of support, which are often provided between group entities, need to be carefully assessed against the definition of a financial guarantee contract to determine if they are financial guarantees. General guarantees for the payment of expenses, employees, shortfalls or deficits, etc. These are typically not financial guarantees. Moving on to initial measurement. Financial guarantee contracts are measured at fair value, which is usually equal to the consideration received for issuing the guarantee. where no guarantee fee is charged or the fee charged does not represent fair value. So if you are in a non-exchange transaction, then the fair value is determined by reference to the price for a similar guarantee in an active market or by using a valuation technique. And if no reliable measure of fair value can be determined, then an entity measures that financial guarantee contract at its loss allowance. Looking at subsequent measurement, financial guarantee contracts are subsequently measured at the higher of the fair value initially recognized less any amortization of revenue and its loss allowance. Loan commitments. A loan commitment is a firm commitment to provide credit under pre-specified terms and conditions. Now, not all loan commitments fall in the scope of GRAP 104. The following loan commitments issued by an entity are subject to all the requirements of GRAP 104. The first type is those that are designated at fair value through surplus or deficit. The second type are commitments settled net in cash or by issuing or delivering another financial instrument. And the third type, which is the last type, are commitments to provide a loan on below market terms, including concessionary loans. Now, the impairment and derecognition requirements of GRAP 104, these apply to all type of loan commitments issued by an entity and not the three that I've just mentioned only. Let's look at initial measurement of loan commitments. This is at fair value and it would generally be the fee charged. If no fee is charged or it's not market related, then the entity determines the fair value of the fee. And if no reliable value or measure of fair value can be determined, then the entity measures that loan commitment at its loss allowance. Loan commitments are subsequently measured at the higher of the fair value initially recognized, less any amortization of revenue and its loss allowance. I want to speak a bit on commitments to provide concessionary loans because these are quite prevalent in the public sector. Now, commitments to provide concessionary loans are seen as a subset of commitments to provide loans on below market terms, except that concessionary loans are provided to achieve specific policy objectives. For initial measurement, where the loan commitment relates to the provision of a concessionary loan, the initial measurement includes both the loss allowance on the loan commitment and the value of any social benefit provided. The subsequent measurement, loan commitments to provide concessionary loans that were measured at their loss allowance, plus the social benefit component, continue to be measured on this basis for subsequent measurement purposes. Important to note here that for subsequent measurement, it's only the loss allowance portion of the loan commitment that changes after initial recognition. The social benefit component remains the same. Okay, moving on to key changes to classification. Classification of financial assets. Looking at financial assets at amortized cost. Now, previously, if an entity had any asset with fixed or determinable payments, it would be at amortized cost. Now, entities need to consider, firstly, management's intent, and secondly, the characteristics of the arrangement. A financial asset is measured at amortized cost if management's model is to hold the asset to collect cash flows, and the cash flows are solely payments of principal and interest. What do we mean by solely payments of principal and interest, or also known as the SPPI test? This means that the characteristics of the arrangement are similar to a basic lending arrangement, where the principal is the fair value on initial recognition, and your interest is the compensation for the time value of money and credit risk, to note that inflation is part of the time value of money. Looking next at financial assets measured at fair value. In the old GRAP 104, which is the one that is currently being applied, these are typically your derivatives, those financial assets held for trading, and those designated at fair value. In the new or revised GRAP 104, if management's model is to hold and sell the financial asset or to sell the financial asset, then they are carried at fair value. Also, if that financial asset does not meet the SPPI test, then they are measured at fair value. I just want to speak briefly about financial liabilities, and I think here for everyone to just note that the impact of the change is expected to be minimal. The default is now amortized cost and not fair value. Moving on to the key changes to impairment. There is a change in the impairment model for financial assets at amortized cost. For subsequent measurement, there is less reliance on fair value for financial assets and a change to how impairment losses are assessed and calculated. The current impairment model focuses on losses that are incurred and focuses on historical information. The new model is based on expected credit losses, and it looks at assessing the risk of potential default based on current and future expectations. Now, the reason for the change is that the information about impairment losses did not allow for timely action or decision-making because information was only available when the losses occurred. The new model allows for more timely decision-making as it provides predictive information. The new model is a two-step approach. The first step is to determine the period over which credit losses are calculated, and the second step is to determine the expected credit loss, or the ECL. This calculation is probability weighted. Let's look at the steps in a bit more detail. Step 1. So step 1 is to determine the period over which losses are calculated. The entity determines whether there has been a significant increase in credit risk since initial recognition. If there has been, then the period over which losses are calculated are over the lifetime of the asset. If the credit risk has not increased significantly since initial recognition, then an entity measures the loss allowance for that financial asset at an amount equal to a 12-month expected credit losses. Now, when we speak about a significant change in credit risk, we are speaking about a significant change of the risk of default occurring. The standard does identify some indicators that may be relevant in assessing the changes in credit risk. Some indicators mentioned in the standard are actual or expected changes in an external credit rating or an internal credit rating downgrade. Another indicator is existing or forecast changes in business, financial, or economic conditions or the regulatory environment that affect the ability to meet debt obligations. For example, an increase in interest rates. Other indicators are also an increase in credit risk of other financial instruments of the same borrower, and also a reduction of support from the controlling entity. Now, the standard does have a rebuttable presumption that the credit risk on a financial asset has increased significantly since its initial recognition when contractual payments are more than 30 days past due. If reasonable and supportable forward-looking information is available to entities without undue cost or effort, then an entity cannot solely rely on past due information. The standard does allow for a simplified approach for receivables and lease receivables. Here, the ECL is calculated at a lifetime credit losses, and the significant change in credit risk need not be assessed. Now, an entity may assume that the credit risk on a financial instrument has not increased significantly since initial recognition if the financial instrument is determined to have a low credit risk at reporting date. So what is low credit risk? If a borrower has a strong capacity to meet its contractual cash flow obligations in the near term and in adverse changes in the economic and business conditions in the longer term. A financial instrument cannot be low risk just because there is collateral in place. It's also not considered low relative to the risk of default of other instruments held by the entity. Low risk is determined by internal credit risk ratings or other methodologies that are consistent with a globally understood definition of low credit risk. For example, your external ratings of investment grade. Okay, I am going to stop here before we go to step 2. I see the slides are not numbered because these slides are quite big, but I just want to, okay, I just want to see if that's 25, 26. We are on 27. I just want to have a look at the chat. I see there are some comments. The first one is, please confirm if new GRAP 104 will be applicable for Fs as of 30 June 2025. The answer to that is no. So for the Fs that you are preparing in the current year, you will apply the old GRAP 104. So what I am discussing now refers to the revised GRAP 104, which needs to be reflected in your financial statements next year when you prepare them. Okay, so it's then for the years ending in 2026. Okay, so I see the same comment. After that, it's just a different financial year end. Okay. Thanks, Elizna. Okay, last comment, then I think we can carry on. Talking about historic data. How historic should that be? 12 months. Okay, so I think when we referred to historic data in this presentation, I think the emphasis on that is that when looking at impairment and when looking at information, it shouldn't be that entities only look at historic data. So historic data could be 12 months, it could even be longer. I think whatever an entity determines is important in their consideration for assessing a significant increase in credit risk. I think what you need to just take out from this is that when we look at the new impairment model, it is not only historic data that should be considered, it is also current events and also future expectations, budgets, forecasts, anything you think that can help you determine the significant increase in credit risk. Now, when looking at future events and things like that, it's not to say that you should know what is going to happen, but if there is information available today about the future, that type of information should be taken into account. Okay, I think we can go on. We are now on step 2 of the impairment calculation, and that is to calculate the expected credit losses. Now, the credit loss is the present value of the difference between the cash flows due under the contract versus the amount an entity expects to receive. It is a probability-weighted estimate of credit losses over 12 months or the lifetime of the financial instrument. This determines on wherever you ended in step 1. Entities must consider what cash flows they expect to receive and when they will be received. This is discounted using the effective interest rate. And important here, entities must use reasonable and supportable information that is available without undue cost or effort. They look at past events, current conditions, and forecasts of the future economic conditions. Entities must consider economic conditions of the borrower, the general economic conditions, current and forecast conditions. They may also use internal or external data or peer group data. Now, the provision for the expected credit loss is recognized in the statement of financial position. The change or movement in the provision every year is recognized in the statement of financial performance as an impairment gain or loss. Okay, so that covered now on a high level the key changes in the revised GRAP 104. Let's look at the transitional provisions. So what are transitional provisions? Transitional provisions provide direction to preparers to implement the new GRAP requirements. They explain how the requirements should be applied on initial adoption. The effective date is 1 April 2025. If entities have chose to early adopt the standard, then they would already be applying the GRAP 104 for their current preparation of financial statements. Now, where do you find these transitional provisions? If you look at our ASB website, under standards, approved and not yet effective, under GRAP 104, you will find the final transitional provisions for GRAP 104. Now, these transitional provisions will be incorporated into the relevant directives when it is effective. It is the same in all directives. That means that the requirements are the same for all types of entities. Okay, we are now on slide 31. I do see a comment, so I'm just going to pause here. Is this new approach of impairment model not the same as the impairment model currently applied using GRAP 108 statutory receivables? The answer here is no. So in GRAP 108, an incurred loss model is applied, which is what is in the current GRAP 104, not the new one. Right, general provisions. What are the general transitional provisions? The general provision is retrospective application per GRAP 3 with some relief. Entities need to apply the revised GRAP 104 retrospectively as if that policy had always been applied. Now, when an entity applies a new accounting policy retrospectively, it applies the new accounting policy to comparative information for prior periods as far back as is practicable. The retrospective application to a prior period is not practicable unless it is able to determine the cumulative effect on the amounts in both the opening and closing statements of the statement of financial position for that period. Now, it is in extremely rare circumstances that this would apply. An entity not taking the necessary steps to gather the information in time, this is not impracticable. The entity should be able to demonstrate that they have taken all reasonable steps. Now, when it is impracticable for an entity to apply a new accounting policy retrospectively, the entity applies the new policy prospectively from the start of the earliest period practicable. It therefore then disregards the portion of the cumulative adjustments to assets, liabilities, and net assets arising before that date. Now, GRAP 104 has to be applied retrospectively. but entities are not required to restate the prior period. So what entities should do is adjust the opening balance of the net assets of the current period to show that cumulative effect of retrospective application. Please note this is quite important. There is a difference between retrospective application versus retrospective restatement. Okay, I see a comment, so I'm just going to address that. Is GRAP 108 going to be amended for ECL model, or will we have two different impairment models for 104 and 108? So, Melissa, this is something we are considering in our current GRAP 108 post-implementation review. I think just important to note here is that if you look at the revised GRAP 104, the old model for impairment still applies to financial assets carried at cost. So the old model is still there, but only for financial assets at cost. For financial assets at amortized cost, that's where the new model comes in. Okay, I think I just want to ask at this point, I've noticed at a few instances my picture freezing. Is everyone experiencing a good quality audio and video? Or are there any suggestions to maybe switch off my camera?
Nabila, you are clear on my end. I can see and hear you well.
Thanks so much. Okay, question, what is the last bullet on this on slide 32? Retrospective application versus retrospective restatement. Okay, so I'm going to explain this again, right? GRAP 104 has to be applied retrospectively. That's retrospective application, which means that entities need to apply it as though it had always been applied. Now, retrospective restatement means restating prior year figures. And this is what is not required in the transitional provisions. So then what entities should do for GRAP 104 is that for the current period, all those cumulative effects, they adjust in the opening balance of net assets for the current period. So if you look at the first time entities apply GRAP 104, you look at that set of financial statements. And if you look at the prior period numbers in those financial statements, those ideally should match the prior year financial statements. There shouldn't be any changes with respect to GRAP 104. What we're saying is take that change and show it in the opening balance of the current year column. Okay, let's then move on. Still under general provisions. So entities do not apply GRAP 104 to financial instruments that have already been derecognized at the date of adoption. Now, entities may early adopt. Important if you do early adopt, and if you already want to show it in the financial statements you're going to prepare soon, that you should please adopt the entire standard, and piecemeal adoption is not permitted. Please to note in the slides going forward that I will refer a lot to the date of initial adoption. This is the date when the entity first applies the requirements. These cover now the general provisions. Let's have a look at some of the specific transitional provisions. We are now on slide 35, classification and measurement. On the date of initial adoption, the entity assesses whether financial assets are held within a management model whose objective is to hold the assets in order to collect contractual cash flows. This assessment is based on facts and circumstances that exist at that date of initial adoption. And the resulting classification is applied retrospectively, irrespective of the entity's management model in prior reporting periods. At the date of initial adoption, entities may designate a financial asset as measured at fair value through surplus or deficit. This designation is based on facts and circumstances that exist at the date of initial adoption, and it is applied retrospectively. Okay, so this is briefly classification and measurement, specific transitional provisions. Let's look at specific transitional provisions for impairment. Now, GRAP 104 is to be applied retrospectively. Entities must measure the impairment losses using the expected credit losses at the date of adoption. Entities are not required to restate comparative information. These adjustments are recognized to the carrying amount in the opening accumulated surplus or deficit amount. Now, at the date of initial adoption, an entity must use reasonable and supportable information that is available without undue cost or effort to determine the credit risk at the date that the financial instrument was initially recognized, and this is compared to the credit risk at the date of initial adoption. Now, if there would be undue cost and effort to determine whether there has been a significant increase in credit risk, then the entity recognizes a loss allowance at an amount equal to a lifetime ECL at each reporting date for that financial instrument until that financial instrument is derecognized. Okay, moving on to specific transitional provisions for disclosure. Now, in the year of adoption, entities need to provide the following disclosure. Please note that this disclosure that we will be going through now is in addition to those disclosure requirements in the actual GRAP 104 standard. Also to note that this disclosure is only required in the year of initial adoption. Now, what's required is quantitative disclosure in a tabular format. This must show the previous classification, the current classification, and the carrying amounts for both classifications. For financial instruments previously measured at fair value through surplus or deficit, now reclassified to amortized cost, disclosure must be shown distinguishing between those that the standard requires an entity to reclassify and those that an entity elected to reclassify. Entities must also provide disclosure to reconcile previous measurement categories and asset classes with the new categories and asset classes. A reconciliation of the ending impairment allowances to the opening loss allowances should also be provided. There is additional disclosure required for financial instruments, classification out of fair value through surplus or deficit to amortized cost. The following disclosure is required. It's their fair values, the effective interest rate on adoption date, and the interest recognized. Qualitative disclosures are also required on initial adoption. These relate to the classification criteria applied to those financial assets whose classification changed, and also the reasons for designation or de-designation of financial instruments measured at fair value through surplus or deficit at initial adoption. Okay, we have now covered the specific transitional provisions. Moving on to the resources we have available on GRAP 104. I think at this point, let's maybe take any questions you have on GRAP 104 before I end off with the information we have available to help you with your implementation. Okay, I don't see anything in the chat, also no hands raised, so let's move on. You are always welcome to, if you think of something afterwards, to just drop it in the chat and then I will address it afterwards. Okay, slide 42. We do have a wealth of resources available on GRAP 104. We have many fact sheets on GRAP 104. The fact sheets are also nicely broken down per type of financial instrument. So if you have a specific type of financial instrument that you would just like to know the requirements about, and also in a simpler, understandable way that's written to maybe easier than the standard or using less accounting jargon, the fact sheets are a nice place to find those. There are also some revised FAQs on GRAP 104. One thing I would really like to highlight is if you look at our ASB website and you look under the menu item supporting adoption of standards, you will find a lot of information available. You'll find all our presentations that we use in our GRAP 104 reference group. This is also nicely broken down into the different types of financial assets, financial liabilities, so you can look at the one applicable to you. It's a nice summary in simpler words of the standard. We do also have a GRAP 104 placemat available. This was newly developed. It is available on the ASB website. And this gives users an indication at a high level of the main changes in GRAP 104 and also the main things they need to consider when applying the revised standard. We do have a flow chart which guides your thought process when looking at loan commitments. Yeah, and I think maybe just lastly here, the only thing I want to say is that some fact sheets can already be applied. I think just specifically looking at the fact sheet on the classification of VAT, we do know that entities still experience some issues with this. So looking specifically at the fact sheet on the classification of VAT, this fact sheet can already be applied now. Okay, that brings me to the end of my presentation. I do see there is a question that I'm just going to take. Okay, so the first comment, I suppose this also applies to debtors when entity does not charge interest. Lennox, I'm not entirely familiar what you are referring to. So if you can maybe expand on your comment, then I can try address it later. Next comment from Sona to confirm. Initial adoption is when we first apply the new GRAP 104, which would be 1 April 2025. Yes, that is 100% correct, unless you as an entity choose an earlier date. But for most of you, it is 1 April 2025. Okay, next question. Can you please cover modification of financial assets? Is it covered in the standard? Yes, modification is covered in the standard. It wasn't covered specifically in the slides. Okay, can the presentation be shared while the workshop is continuing? Members, I think there are posts earlier in the chat with a link to the presentation. We will post it again just in case we have some members who joined late. Yes, and then you can follow on your presentation. Right, thank you everyone. That is it from me. I am now going to hand over.
Thanks, Nabila. Please just let me know if I'm sharing the slides already and if everything looks okay.
Sia, we don't see it in presenter view. We see the notes.
Okay, let me try again.
See, I'm just going to address a question while you try share. There is one asking to please confirm. Previously, we were discouraged to early adopt the new GRAP 104. Are we now allowed to early adopt? Sorry, are we allowed to early adopt? And what would be the reporting date? Okay. So for your comment, I'm also not familiar with why you were not encouraged to adopt. But yes, you may early adopt. At this point, if you early adopt, the earliest you could is to show it in your financial statements for the year ending 2025. So for PFMA entities, March, for municipalities, June. That's the earliest you could adopt at this stage. Otherwise, if you don't, then you have to apply it next year when preparing financial statements for the years ending in 2026. Okay, I will get to the other messages just requesting to reference to specific GRAP 104. And then question by Bongani, do unspent conditional grants fall within the scope of GRAP 104? Can this be included on the financial instruments disclosure note? Could you expand on GRAP 104 paragraph 3G? Okay, I will have to look at what GRAP 104 paragraph 3G says. But basically, if you are looking at unspent conditional grants and you have a contract in place, and if that contract meets the definition of a financial asset or financial liability, or basically a financial instrument in GRAP 104, then it could fall within GRAP 104. But let me have a look at the specific paragraph and I will reply in the chat. Thank you so much. Sia, you can go with your presentation. Thank you.
Thanks, Nabila. I hope everyone can see. It seems okay on my side.
Yes, perfect.
Yes.
Oh, great. Okay, great. Good. Is it still morning? Good morning, everyone. Let me switch my camera on. Good morning, everyone. I hope you will be as engaged as you were with the previous slides or the previous presenters. I will take you through some of the things you need to consider in preparing quality financial statements. So in this section of the presentation, we'll go deeper into some aspects that you'd need to consider when you prepare your financial statements. We will cover topics such as disclosing judgments and assumptions, estimates and uncertainties, and reviewing and amending accounting policies and estimates and how to apply materiality. So we'll go deeper into those aspects in this section of the presentation, starting off with the disclosure of judgments, assumptions, estimates, and uncertainty. So in terms of judgments and assumptions, the accounting standards are principle-based and therefore the facts and circumstances of transactions differ. And preparers inherently apply judgment when they prepare financial statements. So this means that financial statements require preparers to apply judgment in determining what should be recognized, how it should be recognized, and at what amounts. Therefore, it is important for users to know more about these factors as it will help them to understand why certain financial statements may differ, as well as provide information to undertake their own comparison and calculations to help them better predict the future. This therefore means that two preparers might arrive at different answers or answers that are not exactly the same due to what I've just mentioned. There could be various reasons why preparers could arrive at different answers, which means that it is important for users to explain what judgments have been applied, the key assumptions that are used in financial statements, and the areas that are subject to estimation uncertainty when they prepare financial statements. One of the key characteristics of information in the financial statements is that it is verifiable. So making sure that information in the financial statements is verifiable. This means that information provided should allow users to take the information provided and arrive at the same conclusion as that presented in the financial statements. So this is why it is important for preparers to then disclose judgments and assumptions used in the preparation of financial statements. Moving on to the next slide on the key areas of judgment that may apply. Judgment may apply in two key areas, which is the application of accounting policies, and secondly, being the measurement of assets and liabilities. We'll first go into the application of accounting policies. So preparers in this case need to explain to users how the accounting policies have been applied. For example, how control exists over certain assets or entities, or how the existence of risk and rewards is considered in analyzing leases or financial assets arrangements. The second one being the judgment on measurement of assets and liabilities, which includes disclosing management's most difficult, subjective, and complex judgments that are used in the preparation of financial statements that may relate to estimates disclosed in the financial statements. I think specifically entities should disclose assumptions and uncertainties that may result in material judgments in the carrying amounts of assets and liabilities in the next financial year, so that it is clear for the users of financial statements. And then moving on to what it is that preparers should be disclosed or should be disclosed in the financial statements. So it is critical that financial statements include information about management's most complex, subjective, and difficult assumptions made by applying judgment, as well as areas of estimation uncertainty, considering GRAP 1 and standard-specific disclosure requirements. This then means disclosing key assumptions containing the future and key sources of information uncertainty. Information uncertainty referring to where there is a significant risk of material judgments to assets and liabilities in the next reporting period as a result of uncertainty in valuation at this reporting period. This means that entities disclose, for instance, the nature of the assumptions and estimates, the sensitivity of a valuation of assets or liabilities to particular methodology or estimates, etc., the resolution of any uncertainty, information on the assets and liabilities affected, and the carrying amount of assets and liabilities at the reporting date. For example, where the valuation of assets require an assessment of future cash flows and discount rates, disclosure information about the bases and assumptions used in these cash flow projections and to determine the appropriate discount rate, for example, are important, which might include determining depreciation, replacement costs, and calculation of impairment. In considering going concern, preparers are required to provide information about significant assumptions and judgments, etc. So that is, in essence, what you would need to consider in the preparation of financial statements, and making sure that you provide the necessary information to users of financial statements about the judgment, estimates, and assumptions that were taken into account during the preparation of financial statements. Now we'll have a look at the amendment and reviewing of accounting policies, which is one of the areas that normally preparers have indicated that they had issues with. It also has come out as a common issue in the desktop reviews and the post-implementation reviews that we have done. Recently, one being the review on the standard of GRAP on related parties. This was one of the issues that came up where entities indicated that they were unsure about when they'd be expected to review and amend accounting policies. So in terms of the review and amendment of policies, the standards of GRAP describe principles that apply when preparing financial statements. They also then outline the broad recognition, measurement, presentation, and disclosure requirements, which are then not entity specific. So it is then important for users to understand how these principles have been applied by the entity to the transactions, events, or other circumstances that are reflected in the financial statements. This is referred to as the entity's accounting policies, which is the accounting policies that are specific to the circumstances in the entity. It is important to note that entities only disclose accounting policies that are significant to the preparation of financial statements. We will look at an example in the next coming slides. Let's have a look at an example of what is not regarded as a good accounting policy. This is not regarded, I'm not going to read it in detail, but this is not regarded as a good accounting policy as it has the text from the standard on the definition, recognition, and the initial and subsequent measurement requirements. So it is not specific to the circumstances in the entity or how the transactions are treated in the entity. It is rather referring to exactly what is in the standard, which is normally what we find when we do high-level reviews of financial statements, that they are what is exactly in the standard in terms of recognition and initial measurement, etc. So in terms of how we would then go about improving the previous example of what is not a good accounting policy. What constitutes a good accounting policy, or what we'd need to do, should be an accounting policy that explains the items considered as PPE, plus identify the classes of property, plant, and equipment. The accounting policy would need to indicate whether cost or fair value is applied on initial recognition and in what circumstances each is applied. It would also need to indicate what measurement model is applied for subsequent measurement. Is it cost or revaluation? And whether it is different from other classes of assets. In an instance where revaluation applies, it would need to explain what circumstances revaluation be applied and whether fair value or replacement cost is used and how frequently assets are revalued. Obviously, this list is not complete, as there may be various and other issues that should be considered, particularly if entities have complex items or PPE transactions or items, but it's just giving you an example of what it would need or what you would need to include or to improve that particular accounting policy, or what you'd need to take into account. But most importantly, ensuring that your accounting policy is entity specific and not just a copy paste of what is in the standard, but basically showing how it applies to the entity or how the entity has applied what is in the standard. Some basic questions that you would need to consider or ask yourself in terms of developing accounting policies or amending accounting policies would be one, for instance, are there policies for material transactions or events? So in your accounting policy, do you have accounting policies for each or for material transactions and events? Number two being, do the policies deal with transactions and events that occur at the entity? Are they reflective of transactions and events that occur at the entity? Number three, you could consider, do these policies simply repeat the principles in the standard, or again, are they entity specific? Do these policies explain how the principles in the standards are specifically applied by the entity? Again, is everything that you have included in your accounting policy entity specific and not just generalistic, and includes everything that is in the standard that you might not even be applying for the transactions that you have in your financial statements, or might not even be applicable for the transactions and events that you have included in your financial statements. I think we're also working as part of the output of the desktop review on GRAP 20 on an FAQ that we'll be consulting on for those that are part of the PSEF, to have a look at an FAQ that will address some of the issues that normally come up on developing accounting policies and amending accounting policies. So you can look out for that once it is finalized. Let's then move on to reviewing and amending estimates. And then in terms of estimates, we note that the standards of GRAP prescribe periodic review of accounting estimates. For example, the review of useful lives for PPE using the indicators in GRAP 20. As an example, during every account audit cycle, we receive questions about what to do with fully depreciated assets, which we do have an FAQ out that you can find on our website for an in-depth view on us responding to this particular question that we normally receive. So in terms of GRAP 20, as I've mentioned, we have a requirement that indicates that entities are required to assess the useful lives and residual values and depreciation methods at every reporting period. And if an entity has fully depreciated assets at R1, at the reporting date, and those circumstances. In terms of that requirement, it is done by assessing whether there is any indication that the entity's expectations about the future, about the useful lives and residual values of an asset has changed since the last reporting date. So that is why you would need to assess at each reporting date. It indicates that there has been a change, or this would indicate that indications that there would be a change in the expected useful life or residual value of an asset are included in GRAP 17.57, which is what I've mentioned, the indicators, and 58. So then an entity revises the expected useful lives and or residual values when the indicators are triggered, which is one of the areas that normally gets questions. So it is only when the indicators are triggered. In deciding whether any adjustments are required and the nature of the adjustments, an entity would then consider whether the existence of fully depreciated assets results in a change in estimate or results in an error in the financial statements, and then present accordingly in terms of whether it is a change in estimate or an error in the financial statements. And then we will then move on to the disclosure effect. Okay, I thought there was a question there. We'll then move on to the disclosure effects of not yet effective standards. So in terms of not yet effective standard, financial instruments enable users to make decisions about predictive information. Future changes in accounting policies could affect these decisions. So entities frequently just disclose a list of standards that are not yet effective, with some standards on the list that are not relevant to an entity's activities. So a list of standards are sometimes included that are not really relevant to an entity's specific activities. As the purpose of the disclosure is to provide predictive information to the users of the financial statements about the potential changes to an entity's financial performance, financial position, and the cash flows. The disclosure of a list of not yet effective standards is insufficient, as it might not be relating to the entity or specific to what is reflected in the entity. What should an entity then do? An entity should disclose information about those standards that are not yet effective and which are relevant to its activities. So only those standards that are not yet effective but relevant to the entity's own activities. Entities should refer to the list of not yet effective standards of GRAP, which is included annually in Directive 5, which is the directive on determining the GRAP reporting framework. We also have FAQs that provide this guidance that you can find also on our website, that provide guidance on what to include in the financial statements for standards that are not yet effective, and standards which are those standards that have been approved by the Minister of Finance but are not yet effective, and how to disclose in certain instances where a standard has been approved by the Minister of Finance but the effective date has not yet come, such as GRAP 104. which is effective from 1 April 2025. An entity should disclose information about those standards that are not yet effective and which are relevant to the entity's activities. So I think the main point here in everything that I've said is that entities should ensure that the disclosure on the financial statements of the list of standards that are not yet effective is only those standards that would affect or be relevant to the entity's activities, and not what we normally find when we review financial statements, whereby a long list of all standards that are not yet effective are included in the financial statements, and some might not necessarily affect or be relevant to the activities of the entity. Let's then move on to guidance or looking at how to apply materiality or the application of materiality. This is also one of the areas that when we do DSTOF reviews, pre-issuance, post-implementation reviews rather, and other projects that we undertake, when we engage with our stakeholders on the various platforms, this is also one of the areas that normally comes up as an area where entities have issues with, or issues with applying or considering. And we do have necessary information or guidance out there that we have published that is also available on our website. So the standards of GRAP in general only apply to material items. I'll repeat that because that's also one of the areas that seem to be contentious or confusing, that the standards of GRAP only apply to material items. So let's have a look at what our objectives should be when we prepare financial statements in this regard. We should ensure that we prepare or we provide information in the financial statement that provides users of financial statements with relevant information. Relevant information that helps them to hold entities accountable and be able to make decisions. Materiality helps preparers to understand what information will be relevant to users. So that is why it is important for us to provide material information, which is relevant information to users of financial statements. So the standards of GRAP only apply to material items, as I've mentioned. Therefore, materiality should be considered when preparing financial statement, and specifically when formulating an entity's accounting policy or accounting policies, as well as deciding what information to present and disclose in the financial statements. So this does not mean when certain items are not material, they should be basically left out of the financial statements, but alternative accounting treatments should then be applied to those items that are deemed to be immaterial by the entity. Further then on to materiality. Entities should identify their users, identify their information needs, which is the information needs of users, to then get to what is material for those users of financial statements. So that means the steps to follow in applying materiality would be to do research in order to identify, as I've mentioned, the users of financial statements, what information those users would need, and then arrive at what would be material for the users of financial statements. Then apply materiality at the different points throughout the year. As I've mentioned, we have resources such as the guideline on applying materiality in the financial statements, which is available on our ASB website. And one other thing to note is that entities should consider both qualitative materiality and set the threshold for both qualitative materiality and quantitative materiality, which we often find entities only speak of and consider quantitative materiality and not necessarily qualitative materiality as well. And this should then obviously be discussed with management, oversight structures, and auditors, and made available through the financial statements. Let's then look at a few examples on applying materiality. So this slide includes some few examples on applying materiality to recognition and measurement. Then in terms of recognition, this could mean that entities would then reach a conclusion of expensing low value items, which would be, say, for instance, the standard requires capitalization of items where the assets are material. So if there are instances where assets are immaterial, both quantitatively, as I've mentioned, considering both quantitatively and qualitatively, an entity may then decide that in the year of purchase, these items will then be considered as low value items, immaterial, and then expense. Referring to their threshold for what is considered to be immaterial or low value items. But in this instance, it would be important that thresholds should be thresholds should be set at a low enough level so that these assets will never be considered material, both now and in the future. And then also considering an example on capitalizing servitudes as part of the cost of the assets rather than recognition as an intangible asset, which is these could be servitudes are rights to use land. So often you're required to access land for key infrastructure, networks, roads, etc., which could meet the definition of intangible assets. However, if immaterial entity could then decide to treat this as part of the cost of infrastructure of that particular asset. And then some examples on measurement could include expensing transaction costs when measuring financial instruments, as well as using contractual interest rate instead of effective interest rate when transactions are immaterial. Let's have a look at some further example on applying materiality to presentation and disclosure. In terms of presentation, it could include not separately presenting a line items that is immaterial in the financial statements or in the statement of financial position or performance, even if it is required by GRAP 1. So GRAP 1 requires an entity to disclose specific line items in the financial statements, which could be, for example, PPE, heritage assets, intangible assets, etc. But however, GRAP 1 also allows entities to aggregate these items that are similar in nature. So for instance, if intangible assets are immaterial, they could be combined with other assets in the statements of financial position and labeled as other assets. So that is an example of how you would then apply materiality to presentation in the financial statements. And the last one being the applying materiality to disclosure, which could include providing detailed credit risk disclosures, not providing detailed credit risk disclosures if an entity only has a bank account and some immaterial receivables. Entities currently use the disclosure requirements listed in each standard as a checklist, which is what we've seen. So these requirements are included as a checklist, which includes just including all information required rather than assessing whether it is relevant to the entity and if it is material. As I've mentioned, financial instruments are a good example of this. So I think what we're trying to highlight is that it's very important for the entity to consider what is relevant in their particular instance and what is material, both qualitatively and quantitatively, and establish the thresholds, identify what the users are, and apply that in terms of what to present, disclose, recognize, and measure in the financial statements. I think I've reached the end of my presentation this morning. I see quite a number of questions that I think I might have skipped, but I see Elizna has responded to those ones. Yeah, I think Elizna has responded to most of them. I can respond in the chat to those. I'll just read through and see what has not been responded to and then respond in the chat, unless anyone wants to unmute and pose a question. I don't see any hands, so I'll hand back to you, Elisna, and then I'll just see on the chat if there's anything else I need to provide clarity on or respond to. Thanks.
Yeah, we do have one hand from Kayambadi, and he can just help me with pronunciation when he's able to unmute. I have allowed access to your mic. You are able to unmute now. Please go ahead. Kayambadi, you should be able to unmute now. Please go ahead. It seems like you are from Gauteng Department of Health.
Can you hear me?
Yes.
Good morning. Thank you. Yeah, saying a very important and very beautiful, presentation. Thank you so much, especially when you touched on the review of the accounting policy. But my question is, saying, just imagine you've reached a threshold in terms of the PPE, and you decide for interest sake, let me say threshold of 2,000 Rand value of assets below that is going to be, written off. Yeah, you find that with time, the AG's approach is just to escalate and accumulate that figure, and you are actually required to keep what we call a minor asset, PP asset. Now, the point is, to what extent do I have to make sure that I'm safe as an entity, that at some stage I'll reach another threshold, set by the auditor general to say that, look, it has become accumulatively a huge figure and you should actually be capitalizing. I'll stop there and listen. Thank you.
Okay, perfect. Thank you. I'll take the question as it relates very specifically to IGRAP 21. So I think that would be my first recommendation to you is to have a look at IGRAP 21. We do deal with your specific question in a lot of detail. In that IGRAP, we have examples, and I think the principles are also clearly set out there. So to start off with, first things first, we clarify in that IGRAP that materiality is a period-specific assessment, and you do estimate materiality each period based on the circumstances at the time. When you set materiality, you do consider possible future changes. So you make sure that what you set as your threshold is appropriate for changes that you know of, and you do consider that when you determine alternative accounting treatments. So for example, if you don't have a lot of property at the moment, and let's say it's something small. So let's say you don't really have office equipment like desks and so on at the moment, but in the next year there's going to be a change and you are going to take over a training facility and have a lot of desks all of a sudden, and they will be material from next year. Then you are going to think about that this year, and you're not going to set a threshold that would mean that next year you have to change from something that's previously been written off to now recognizing. But with that being said, if you have done that and you have properly assessed your materiality in a period, then that is not something that you need to go back forever, and you do not need to accumulate those things that you have treated in a different way because you have determined materiality appropriately, and that was all in accordance with the standards of GRAP. It's only if you have made an error where you would need to go back and start recognizing things that you've previously treated in a different way. So if you've made an error in IGRAP 21, we give examples and we explain when you would have made an error. Otherwise, you don't need to go back. So I think the IGRAP will probably answer the questions that you have, but no need to accumulate those items. Abraham, please go ahead. Let me just give you access to your mic, and you should have that now.
Thank you very much. There's a bit of inconsistencies for fully depreciated assets from AG's perspective. You may find that these assets were fully depreciated in the prior years, for example, and they remain at R1. And in most cases, there's a lot of debate from AG, depending on who's auditing, whether you can retain them as assets fully depreciated and disclose them and disclose the fact. Or alternatively, you decide to treat it as an error and reverse those prior depreciation, which require a lot of work to do. What is normally what we call advisable in these instances if you find a lot of previously depreciated assets?
Yes, so I think that's, as Sia said, something we hear about in every audit cycle and why we have developed the FAQ. So I think the position of us as staff is that it is inappropriate to have assets recognized at R1 or R0 or any other nominal amount that is inappropriate. So you would need to make adjustments, and we have in our FAQ followed a process of step-by-step explaining how you need to assess what type of adjustment you need to make. So there's a flow chart explaining when it would be treated in one way or the other. So I think that FAQ is really going to respond to your question and what I would suggest that you look at. Thank you very much. I don't see any other hands. We do have a few questions in the chat that we will respond to. We are now at the point in the agenda where we are due for a coffee break. Okay, sorry, let me just take one last person before we break. Ntiki, please go ahead.
Thank you very much. No, just to top up on the previous speaker on the same issue of fully depreciated assets. Look, I checked the frequently asked questions, and one of the things it mentions is that at a specific reporting period, when an entity has assessed that it needs to review the useful life of the fully depreciated assets, they will perform that review and adjust financial statements if material, not material. But now the question I have is, one, now it's a frequently asked question, right? Can you make reference to it as part of the submission to review the fully depreciated assets, one? And then secondly, if the frequently asked question is saying, at the reporting date when the management has made an assessment that it needs to review, does that give a time frame in terms of, I'm just trying to say, is a specific time frame that is given that, because it says an entity may have, look, I take it that you're not supposed to get to a point where you've got full depreciated assets, but if in instances it does happen, you do get to that point, is a specific period that says you can stay with full depreciated assets for this period, but not longer than this period, because it's not specific in terms of timelines and periods, but it says when an entity has assessed that it has those assets, then they can review and make adjustment if it's material, depending on how it has been assessed. Thanks.
I thank you for that. So if I understand the question correctly, I'm going to respond how I understand it, and you can let me know if it's not dealing with your question. So the standard of GRAP requires you to review that at every reporting date. So that is the requirement of the standards of GRAP. You report in terms of the standards of GRAP every year when you prepare your annual financial statements, and legislation gives you the timelines for when that needs to be submitted to the auditors and when the auditors need to sign off on that. So I would say in terms of the standards, the requirement is every reporting date. Then legislation comes in with timelines that you have to prepare those reports, and you would then need to do it within those timelines. So I think it's kind of reading GRAP and the legislation together to get at the timelines. I'm going to take one last question before we then take a break, and the rest of you are more than welcome to post anything in the chat. I think if there's anything particularly controversial or difficult, we may just pick that up and share that before we commence after the break. But Kiwi, please go ahead. I have allowed your mic, and I think you would be able to unmute now. Kiwi, would you try unmuting? Let's see if you can unmute. You should be able to. Then you may share your question. Okay, I don't want to delay the break longer. Yes.
Am I audible?
Yes.
So you can hear me?
Yes.
Thank you so much. I've got two questions, and my two questions are relating to the two previous speakers. One is relating to minor assets. In our accounting policy on asset, we expense any asset individually that has a cost of 2,000 and less. Now, I heard the previous speaker working at the Department of Health saying the age now, they are looking now on these assets accumulatively, that it may result in them requiring that those assets become capitalized. Now, my question is, the policy, can't we stick to the policy, because the policy is saying individually, this asset, if it's a microwave, is less than 2,000. I don't capitalize it. Therefore, it goes on the register of minor assets, and therefore it is expense. At what stage now will AG have to come to us and say, this treatment that you are doing is not correct, because cumulatively now your register of minor assets have reached a threshold value? I do not know, you provide guidance on that. Number two, the assets wherein their carrying value is sitting at R1. In terms of the accounting policy on asset management, we do a review of those assets annually. Now you see that these assets that have depreciated and they've got a carrying value of R1, but when you actually look on this asset can still function. So you want to do a conditional assessment whereby you increase the useful life of this asset. Now, what is wrong with that? If you extend the useful life because of the condition of this assets, you see that it can still work and deliver on whatever are using this asset to do for you. Is there something that is not correct in you extending the useful life of this asset and then doing your depreciation again and reversal, and you do all your year-end accounting entries in accounting for this asset that we have done a revaluation on them? I just need an explanation on these two. I have noted the fact that there is a frequency asked question on IGRAP 21, which I will go, but for this purpose, on this discussion, on this platform, I would like an indication of the pointers, and in your own understanding, what should be the position of AG on these two matters that I've just presented now, in addition to the other speakers that have also raised similar issues on these two asset categories. Thank you.
Okay, thank you. I'm just going to quickly deal with this, and then we are going to take a break. So firstly, it's the response that I gave to the other person, that in terms of IGRAP 21, you are not required to accumulate for future restatement items that you've treated in accordance with alternative accounting treatment. You are in the standards of GRAP. If you are following an alternative accounting treatment for immaterial items, you're allowed to do that. No need to accumulate, no need in future to to then bring them onto the books if accumulatively over time they become material, for example. So that is explained in IGRAP 21. Unless you have made an error, then you may need to go back. Then in terms of the useful life assessment, that is exactly what the FAQ explains. At the reporting date, your assets carrying amount should reflect the future economic benefits or service potential that is still within that asset. So if you do still have service potential or future economic benefits, and your asset is sitting at R1 or R0, then you do need to make an adjustment to reflect the future economic benefits and service potential that is still within that asset. So we explain the ways in which you make that adjustment in the FAQ. So I hope that helps. And
Ilesna, you're on mute.
Yeah.
Thank you. So I hope that helps. And at this point, we are going to take our 15-minute coffee break. We will resume again at 11:30. Enjoy a quick break, and we will see you then.
Thanks, Elizabeth. Tabelo, you may please write your question on the chat and then we'll respond on the chat. I see he's got his hand up. Thanks.
Hello, everyone. I hope you enjoyed a lovely break. We tried to respond to the questions that you posed in the chat. And I say try because there were many, so we may have missed one. Apologies if we did miss any questions in the chat. I think as far as I'm concerned, we have responded to all. So if we didn't respond to yours, would you mind please reposting? Then I think it will be easier for us to pick up if we just start with a new feed from now on. But for those of you who have asked, please look, they are sort of mixed in between questions and answers on the chat. You may have to scroll up to find the response we gave to yours. So thank you. The interaction has been great. We really appreciate the fact that you are tuned in and responding to what we are saying. And the questions also help us to gauge where the issues lie in the environment and where we may need to give more guidance or raise awareness about guidance that we already have. And that leads me quite nicely into the next item on our agenda, the ASB's work program consultation. So the purpose of this consultation or this part of the presentation today is not so much to have an interactive discussion and get a lot of comments while we are presenting. Unfortunately, we do not have enough time for that today. What I would want to do is to raise awareness with you about the exposure draft. And I am going to share a survey with you in a few slides where you can respond to the questions as I'm going to talk through them. So what I want to do is give you a background, explain the questions that we have in the exposure draft to you. And while I'm doing that, you can, on the survey, respond to the questions. I will also share with you a link. I'll do that, a link in the chat when we get to the survey slide. The survey slide is a QR code if you want to respond on your phone, but there is also a link that I can post in the chat if you want to type the responses on your laptop or keypad. Okay, so let me give you some background and explain to you what this consultation is all about. So what is the ASB's work program? I think I'm going to take a slight step back and explain why do we set standards of GRAP. So in terms of legislation, we are required to set standards of GRAP for public sector entities on all levels of government, national, provincial, local. And there are even other entities, not in terms of our mandate, but in terms of specific ministerial directive that apply the standards of GRAP, such as in the education space, the colleges. We do therefore need to set standards of GRAP that would meet the needs of a broad range of users, and we therefore refer to them as general purpose financial statements, meaning they are not intended to meet all the needs of every single user. We do need to provide a level of information that would satisfy a broad range of users. And with that, with the diversity we have in the type of entities that apply the standards, it also means that we would need to develop requirements that would cover a broad range of type of transactions and activities. Sorry, so that is typically what we think about when we look at what the work is that we need to undertake and do in a specific period. Then also just to mention, what do we mean when we say we develop standards of GRAP? So I think you may all know that we have a suite of standards of GRAP, starting from GRAP 1 all the way to GRAP 110, living and non-living resources. The standards of GRAP are authoritative. You have to apply them to assert compliance with the standards of GRAP. Then we have interpretations of the standards of GRAP, and they are also authoritative. So again, you have to apply them to assert compliance with the standards of GRAP and to be able to state that your financials are GRAP compliant. The third type of pronouncement that we develop is guidelines. Guidelines are by nature or by default, I would say, not authoritative, but our board can make them authoritative by including them in Directive 5 as part of the GRAP reporting framework, which really means that entities have to apply those guidelines that are included in Directive 5 as part of the GRAP reporting framework. So just to be more specific here, what we currently have, we have 3 guidelines. The landfill site guideline and the housing guideline are both made authoritative in Directive 5, so you have to consider them when you prepare your financials. The materiality guideline is not effective. We encourage application of the materiality guideline, but you do not need to apply it to assert compliance with GRAP. Then our board also issues other non-authoritative materials, usually as an outcome of our projects. We have research papers, we have review reports, and those are published by the board, but they are not authoritative. So they aim to communicate the outcome of our projects and help establish practice and bring alignment where there is diversity in practice. We also communicate next steps that we are going to take from projects, as well as raise awareness about existing guidance that already address the issues that have been raised in our projects. So research papers and review reports, they are particularly useful to look at when you prepare financials. It may just respond to some of the questions that you have. Then what is our work program? So I think this is the most important document that we have. It determines the work that we will undertake in a 3-year period. We do formally consult our stakeholders on our work program to make sure that the work program considers what our stakeholders need above our own ideas of what we think we should do. And it makes sure that we give the right priority to projects. So you will tell us how urgent the projects are, and we will plan the work that we do in that way. So year 1 will be the most urgent work, year 2 and year 3 are less urgent work. So that is why it is so important for you to be part of our work program consultation. We do need to hear from you what we should do and what you think priorities should be for us to be able to have projects that are relevant and useful to our stakeholders. So although we have a board approved 3-year work program that is determined upfront before the 3 years start, we can change the work program should there be changes in the environment that necessitates us to reprioritize or deprioritize some of the projects maybe into a future work program to make room for something else that came up. So we can certainly do that, but we do try to execute what we promised in the work program at all costs. So this slide is just to show you how our timelines work this way around. So we have a new strategy that commences this year. It's from 1 April 2025 until 31 March 2030. And the work program that we are consulting on now falls squarely within our new strategies period. It's from 1 April 2026. So we refer to it as the 27 year, 26-27, until 31 March 2029. So we are now at the point in our work program cycle where we need to identify the projects for our 1 April 26 to 31 March 29 period. And we need to make sure that those projects that we include in our work program align to our strategy. So I'll tell you a bit more about what that strategy and theme is in a few slides. So when the board receives feedback from stakeholders on our work program consultation, the board then needs to take all of that feedback and put it into a plan by selecting the projects that we want to and can undertake and then prioritizing those. And we don't just do that by applying a thumbs up. We do have criteria in our due process handbook that we apply to make those decisions. So I'm going to, on the next slide, share the criteria with you because it may help you to decide what input to give us if you already know what the board is going to consider at the end to put the program together. So we are a very small staff complement. I don't know if you are aware, but the ladies that you see today are the ASB ladies. We are the standard setting team, myself and the 3 standard setters, Nabila, Amanda and Sia. So we are not able to undertake the same amount of projects as some of the international standard setters, for example, and we need to make sure that we respond to local needs and not just align with international work. So there is a limited amount of work that we can undertake, which I think makes this consultation even more important, because we cannot just do everything. We have to know what is most important for you and what would you like us to do and prioritize. So then, consulting on our work program, just a bit of administration on this slide. We have published a document that is ED 11, the official exposure draft that consults you on our work program. And we have included in that a whole lot of information as background, and then some proposals from our board with the questions that we are asking you. So we do different types of work, and we ask for each of those types of projects what you think we should look at. I will talk through that in the next few slides. So access the documents, please, on our website, ED 211. The comment deadline is 14 March. Until that period or until that date, we will still have a few roundtable discussions, and you can send us written comment at any point up until that date. You can send us written comment to info@ASB or my own email address. And I'm going on the next slide to share with you the first, sorry, I'm distracted by a comment, but I will share with you on the next slide a link to the survey, which is another way to send written comment. So just to say again that the slides themselves are available on our website, as well as a recording of today that we will make available afterwards. So with that, I'm just going to ask one of the ladies if they could please share again the link to the slides on the chat. It has been shared earlier. And then I would like to share with you on the next slide the QR code. So please use this to access the survey so that you can respond to the questions as I am going to explain the background over the next few slides. So I'm just going to give you a moment to use your phone and access the survey through the QR code. And then what I also want to do, if you don't want to use your phone, then you can, through a link, access the survey. And I'm just going to post that quickly for you in the chat. Okay, please send me a message if you are unable to access the QR code or the link. If neither of those work for you, we can see if there's an alternative way for you to access. Okay, thank you, Nabila. I see Nabila also shared again with you the link to today's presentation. So afterwards, while we're going through the slides now, if you don't feel that you are ready to respond to the questions and you just want to listen to what I'm explaining, that is also perfectly fine. You have access to the slides afterwards. You can access the QR code afterwards, and the link will now be in the chat. It is there for you to access the survey afterwards on your laptop if that's what you prefer. Maybe just give me some thumbs up if you have been able to access the survey. Okay, I do see some thumbs up. Okay, great stuff. Thank you. So let me then continue to talk you through the proposals, and I will share the questions on the slides as well, so you will know which parts I'm talking about. The first part is just generally to share with you the theme of this work program consultation, so no specific questions are linked to this part. I think if I just take a step back, maybe we are currently midway through the 24 to 26 work program. And this is now the period when we need to start thinking about what next. When we consulted on the current work program 24 to 26, at that point already our stakeholders told us that we should not roll out a whole lot of new requirements in this period. We should rather focus on taking stock, which is the theme for the current work program. And that meant a shift in the board's focus, so away from developing requirements to rather maintaining the standard that we have, making sure that they are still relevant and there are no issues with them being inconsistent, etc. And then also helping our stakeholders to apply the standards. And we have, as a focus here, some work we do to enhance the application of the standards. So I think the shift away from developing new things to maintaining what we have and supporting you with what we have has been well received by our stakeholders. The theme for 27 to 29 that we are proposing in this consultation is financial reporting for a capable state. And this speaks to our strategy and the key priorities of this new administration to build a capable state. And we do see that as quite an important role that we play as the public sector accounting standards setter to help government to achieve that key priority. So what this theme means is that we propose that the work that we undertake in this period builds on the previous work program. So we continue along that same path and we focus on supporting our local stakeholders with their ability to produce high quality financial reporting in our South African public sector. So to achieve this goal, the consultation proposes that the activities that we undertake are centered on stakeholder engagement and support, while to some extent still maintaining the existing standards that we have, and then to a lesser extent developing new reporting requirements to fill last remaining gaps in our guidance. And we will get to then the more specific activities that we think we need to do in various areas of our work over the next slide. So in a nutshell, we propose to continue with the same theme that we've had before and go even further down that path, a path of supporting you instead of rolling out a whole lot of new requirements. So let's talk about the first area of our work, which is to look at whether there are any gaps in our literature that we need to fill. So that's one type of project that we can undertake, is to fill gaps by developing guidance to address those gaps. I think up to now, we've known about non-exchange expenses being a gap. We have currently projects ongoing to fill that gap. The cash social benefit standard is almost complete, and we will work on in-kind social benefits within this next period, as well as intergovernmental transfers. Then I think as there's always new transactions or new arrangements that enter into our environment, it is important for us to identify these issues and these new areas where we may need to provide guidance as part of this consultation. So that brings us to the first question, and you should see this as a question on your survey as well. It would not be numbered 1 because we do have first questions, as you would have seen, about your background and so on. But the first question relating to the consultation is, are there any transactions or arrangements that require accounting guidance from the ASB? So this is not just to say that that there are new transactions or new things that happened, that means we now need to give guidance. It could be that all along there have been transactions that we never picked up or that have never been material in the past, and you need guidance on. So please indicate in your survey response now what areas you think we need to develop guidance. It's also possible that you are happy with us, that we have already covered everything that you need guidance on. And when I say guidance, I mean now requirements in the standards of GRAP that deal with a transaction or event. Later on in the questions, we'll get to areas where there are standards of GRAP, but you have difficulty applying those and you need guidance and support in applying those. We will get to that later. This part is just about no requirements in the standards. There's a gap in the literature. So if there's nothing that you've identified, then you can just have a quick response to say nothing, and that is also perfectly fine. Okay, so let's then look at the next area. So apart from filling gaps, we look at international developments. So in terms of legislation, our board is required to consider best practice locally and internationally in developing standards of GRAP. So most of our standards and pronouncements are based on IPSAS, the International Public Sector Accounting Standards. In some rare instances, we went to the private sector guidance, IFRS accounting standards, where there was a gap in IPSAS. But those areas have significantly diminished. But it's not to say that we can't again look at it, look at IFRS if there is something that we think that they've rolled out that's important and the IPSASB has not picked that up as a project. We can always do that if our stakeholders feel it's important to do that. So it's a part of our ongoing activities to track the work of international standard setters, private and public sector, and to assess what we think we need to do. And this is part of our mandate. I think what we have heard from stakeholders, not to put words in your mouth, but in the past we have heard that some of the latest international standards, they are complex and difficult to apply. If you think about revenue, financial instruments, this is now limited entities, but insurance contracts, leases, all of those can be difficult and complex to apply. And we have heard from our stakeholders that we should not just align for the sake of alignment. We do need to make sure that the work that we do responds to local needs first and foremost, and we should not just, to put it plainly, change for the sake of change. Sorry, I did not mean to move yet. So what that has meant for us is listening to those kind of comments. We introduced an initial step in our international work, which means that we first pause and assess what would be the impact of that international standard should we apply it locally. And we undertake a bit of research to understand what our environment would look like with the change, whether that is a change that would mean that there is better information for users. Is it something that is possible to apply for preparers? So we look at it from all angles, gather information, and then our board makes a decision about whether or not, and if so, how to take forward that international project. So we are not just simply aligning and automatically taking on international projects when there's new guidance internationally. So on the next question that you will see in your survey, what international projects should we take on for this next period? I firstly just want to give you a bit of information about what we are already doing, and then you can see what other projects you think we need to do. I just also want to mention that if you access the exposure draft on our website, if you open ED 211, you will see that we have a long list in table 2 in the consultation document that explains all the latest international standards, with some commentary on the side on what we consider to be feasible as projects in this next period and why. What may be particularly important is why we consider some of them to not be feasible in this period. And we will then consider based on your feedback also what we should be seeing as priorities. So to not go into too much detail, we are already working on a measurement project, and we are also looking at first steps on revenue. So for both of those, we would probably still be busy with that in 27 to 29. At this stage, we don't want to put a specific number to how many new international projects we can undertake in this period. It will depend on a balance of our resources and what the priorities are that you tell us we should focus on. So it may be that we do no other international work, or if you tell us to please make this a priority, we can do 2 projects. We will make that assessment based on your feedback. But based on table 2 in the exposure draft, our board believes that we can undertake 1 of 2 international projects potentially. The first one is to work on leases. So earlier on in Amanda's presentation, we showed you IFRS 16 and that the IPSAS-B issued IPSAS 43. They, in IPSAS, included specific guidance for public sector leases where it's not necessarily market-related leases, and even those that have 0 or nominal consideration being paid, they could not be in the scope of the leases standard, but other guidance have been developed by the IPSAS-B for those. So that's one project we can do. Or if you don't want us to go that route, then GRAP 13 exists and is being applied at the moment and should be continued to be applied. The other international project we could do is to update our framework. And this is more for us as a standard setter potentially, but it does impact you, of course, because the framework is what we use to develop our standards. So we can update to the latest international framework, which means that we would then be using the latest international thinking when we develop the standards. But if there are other priorities, then we have our current framework, and that is what we will continue to use to develop standards. And that is then the next question to you: what international projects should the board undertake? And I think I've mentioned now 2, the framework and leases, but in table 2 in the exposure draft, there are many others. If you are aware of other IFRS or IPSAS standards we should be doing, then you can tell us about those. And again, an option is for you to also say that what we currently already have planned being measurement to be completed and revenue to be commenced. If you think those are sufficient and nothing else, then that's also a good indication for us. Okay, so then the next type of project that we do is maintenance. I'm going to explain this very quickly. We have 2 activities here: improvements and Annexure 5, and the annexures to Directive 5 that we update every year. These are standard activities that we will definitely do in 27 to 29. When it comes to improvements, we do have an element there of looking at your local needs that you have. So if there are any minor changes that you think are needed to the standards, then we would like to hear about those so that we can pick it up in the improvements project that we are going to undertake in any event. So that is then the next question, to ask if you are aware of any enhancements or amendments that are needed to the standards of GRAP, and to give us a bit more information then about those, such as what the name of the standard is and what the issue is. And it would maybe be helpful if you have specific paragraphs in mind, etc. If this is not information that you have at hand, you can always email that afterwards and we will add it to our improvements list. We sort of keep a running list going throughout the 3 years. We keep adding to possible improvements, and when we do the project, we pick all of those up and assess what we can do as part of the improvements, or what maybe needs a separate project, or sometimes if it's really minor, we can even just do it with our annual handbook updates. Okay, so that is the maintenance activities. I am now on slide 79. Sorry, I haven't seen anyone being lost in the slides for a while, so I forgot to say that. We are now on 79. So then the next type of activity that we do is we review the standards of GRAP that are effective and have been applied by entities for a while. We look at effective standards because for these projects to really yield results and give us useful information, we need entities to have applied the standards for a couple of years already so that they are very well familiar with what the issues are, and there is practice that has been established. So there are two types of reviews that we do. Post-implementation reviews are resource intensive. We follow the board's due process to publish a consultation document, and we have a public consultation process that we run for an extended period of time. To give you an idea, post-implementation reviews, we often consult for as long as 9 months on those, whereas other exposure drafts, we typically consult for a period of 4 months. So it's vastly different and very resource intensive, both from us as well as our stakeholders, because we need your inputs to get good information. We then, after this, publish a review report, usually for both types of projects, actually. And usually post-implementation reviews lead to next phases where we change the standards based on the issues that we identified. The other type of review is a desktop review. This is less resource intensive. It does not involve a due process. We do not publish anything for consultation. We have work that we do behind the scenes to identify issues, and we may have limited engagement with our stakeholders to test what we saw and what we found, and to brainstorm a bit what could be the best next steps for us to do. Often this leads to FAQs. We would also usually publish a review report to communicate the findings. So on this next slide, I have a bit of information on the projects that we've recently done or are set to do. So this would give you some indication of what we've already done. And I think it is slightly less likely for the board to pick up one of these again as a review project, because we have already done them. Some of them we will still do, as I said. But that being said, if you think there's a need for us to circle back to one that we've already done, you can by all means tell us that, and we'd be happy to hear that. So this is now leading into the next question, which is what the reviews are that we should be doing. Maybe while you are responding to that question, I'm just quickly going to go through the slides. So we have done a detailed post-implementation review on property, plant and equipment, as well as on investment property. On heritage assets, we've done a desktop review on presentation, as well as, so that was the statement of financial performance, also on cash flow statements and budget information in the Fs. So GRAP 1, we've done GRAP 2, as well as GRAP 18. We've reviewed Directive 12 for those entities that may need to apply another framework where GRAP is not the best framework for them. Then we've done a detailed post-implementation review on GRAP 109, and we are busy with the next steps from that. We are busy wrapping up the consultation on our post-implementation review on statutory receivables, GRAP 108. And we have just concluded our desktop review of GRAP 20. The review report for that is available on our website. We are going to start a review of GRAP 18 segment reporting in this year. So that is already on our list in case that was something that you wanted us to look at. We are going to look at that already in this year. So that is the first part of the next question: which standards should we review? And it could either be post-implementation or desktop that you tell us about. And if you don't know which one, you don't need to be specific. You can just say review standard X, and we will decide whether it should be post-implementation or desktop. Then the other part of reviewing the standards, and this is not necessarily a standard, but other pronouncement that we have is materiality. So I spoke to you earlier about our materiality guideline, which is not a required pronouncement, but entities are encouraged to apply it, and we would want entities to be applying this so that practice can develop and the environment can mature a bit since when we initially issued this. I think in every project that we do, this comes up as an issue. Even today, we've had quite a bit of discussion about materiality and alternative accounting treatment. It remains an area where there's difficulty in applying it, and I think it often leads to disputes, to be honest. It's, of course, an area where a high degree of judgment is needed by management, and that is always an area then that is difficult to apply. So this is a project that we also propose to do, to circle back to materiality and see what the issues are that exist at the moment. So this is the other part of the question about reviews, is whether you agree that we should do the materiality guideline. And if you don't think it's needed, please let us know. Then the next part of the work that we do, and this is mostly us as the secretariat that does the work, not so much the board, is that we facilitate and encourage stakeholder engagement and support. So communicating information about the standards and their adoption, things like issuing FAQs and fact sheets and other communication material, and facilitating discussions on the application of the standards, all these activities are critical to our work. So our primary communication tool is the website, but we have platforms, social media platforms where we communicate often as well. And I think earlier on there was a question about that, and I've posted links to all our social media platforms earlier on in the chat. You can scroll up if you missed that. So this is an area where we've spent a larger proportion of time on in the last work program, the one that we are currently in. And I think looking ahead and the theme that I communicated up front, we propose to spend an even greater proportion of our time in this area going forward. So for 27 to 29, we want to invest more time in this area. Enhancing the application of the standards of GRAP is a project that addresses key issues related to how the standards are applied, and we will speak to you a bit more about that later on. We have YouTube content on various topics. We have communiques that explain changes to the standards, and we have a work program for this, and we want your input on what the projects are that we should cover here. Under supporting adoption, we currently have the GRAP 104 reference group, and that will probably conclude within the next year when the standard is implemented. But we will assess what the need is to support our stakeholders. So all of these activities that we are currently doing, we plan to continue with, and even to a greater extent in the next work program. There's one more complex standard that will become effective, social benefits. We want to establish a reference group for that. It will be a limited number of entities, however, that would be impacted by the standard and involved in that. If you don't know, you should know that we have a GRAP Knowledge Hub. The Office of the Accountant General is the custodian of that. They are, of course, a very important stakeholder for us. They support you with resources such as the GRAP accounting guidelines, and they respond to technical queries. And they have developed this knowledge hub with our inputs. And it is available now. We launched it last Friday. If you don't know about it, then I think I'm just going to ask one of the ladies if they can please help me to share the links to register for the Knowledge Hub on the chat with you quickly. We've been communicating about that, and we do have quite a few links as well to share with you. A recording, for example, about Friday's launch. So what we want to do from our side, why this is on our radar, is we want to put resources aside in this period to help the OAG by contributing material to the Knowledge Hub and to help maintain what is already there. So the idea is that that is a central place for you to go for all things GRAP, and we don't want to therefore be doing our own thing while we can do something cohesively with the OAG. Thank you, Sia. I see Sia did now post the link for you there. So we do have a couple of questions in the survey that asks about the themes and issues for our Enhancing the Application project, what the content is that you would like to see on the Knowledge Hub, and any other activities that you would like us to do. So this is basically the end of the work program consultation. The last part is more information sharing about emerging issues. And we do have questions about what you think those are. And on sustainability reporting, this is not our area of expertise. So if you have contacts that you can share with us on sustainability reporting, then please share those with us in the survey as well. I'm just briefly going to touch on that to say that at present, we do not have a clear mandate to set sustainability reporting standards, and we do not foresee that being part of the work program that we are consulting on now. We are in this area part of discussions about what should South Africa do in this regard, and it may be that we are able to start developing these standards in future. If that happens in the 27 to 29 work program period, then you will be consulted again on what sustainability projects we should undertake. Status quo means that we are not currently resourced and not asking you for inputs on such projects. On employee compensation, that is something else we want to pick up in our next work program. It's something from our previous work program to look at information on short-term benefits that may be useful. So those are the emerging questions, emerging issue questions. And other feedback, as usual, you are very welcome to share with us any other feedback that you have on the work that we should do in this period. So I am going to wrap up at this point and then hand over to my colleagues, Nabila and Amanda, to take you through the exposure drafts that we currently have available for comment. I'm just going to say thank you in advance to everyone who completed the survey. If you haven't, please then do that afterwards, and I will have a look at the responses in the chat while I hand over to Nabila and Amanda. Thank you very much.
Thank you very much, Elisna. I hope that my earlier issues with the network has been resolved. So I'm going to take you through the first exposure draft. That is a proposed Ipsos on tangible natural resources. And then the other document that's out for comment is on the sustainability standard that Nabila will take you through that. So in 202, just a little bit of background around the development of the standard. So first of all, there isn't international guidance currently available on how to account for tangible natural resources. And as part of the IFASB's consultation, the respondents came back to say that they actually, that for some of the entities have quite a big portion of tangible natural resources that they don't currently account for. So when you have a look at the financial statements, there's not really much to see, or there's no monetary information available around the tangible natural resources that are under their control. So to address the lack of comments in that area, sorry, my slides has just been going a bit too quick. So to address the lack of guidance on tangible natural resources internationally, the IPSAS-B has developed guidance on the recognition, presentation, measurement, and disclosure requirements around tangible natural resources. So typical examples of a tangible natural resource that will fall within the definition of a natural resource will include water, will include living resources like animals and plants, as well as subsoil resources prior to it being extracted. So in terms of that, the important definition for us to note is what is a natural resource? So in terms of the definition, it is a naturally occurring item which embodies service potential or the capacity to generate economic benefits or both. So just on comparing that to us locally and what is the impact for us from a local perspective. So currently we have GRAP 110 on accounting for living and non-living resources. So for this time being, that is a standard that entities need to comply. When the IPSAS-B finalizes their project, the board may at a future point in time consider whether or not the principles within this exposure draft or the final IPSAS is then applicable to local circumstances, or the board may also decide to update the guidance that we have in GRAP 110 with that's internationally available. But the board will follow its normal due process in order to do that. So for the time being, there isn't any changes to the local requirements on GRAP 110 that you need to consider. However, it is still important for us to provide comments on that, because the board may at a future point in time consider the guidance, and therefore it's important to participate in the processes which Nabila will highlight towards the end of her presentation on ED 212. So just on the scope, so the post-exposure draft is saying that any tangible natural resources that fall within the scope of this standard will be those that first of all meet the definition of a tangible resource, but are not accounted for in terms of any of the other IPSASs. So if you, for example, have water in a controlled environment, and your intention for holding the water is to sell the water or to distribute it at no or nominal consideration, the water does meet the definition of a tangible natural resource in terms of this standard, but because it falls within the scope of IPSAS 12 on inventory, you account for the water in terms of that standard rather than in terms of this standard. So from that perspective, the proposed IPSAS is a residual standard. So if it doesn't fit within the other asset-related standards, you will account for it in terms of this standard. In terms of that, there is an alternative view around the scope and the definition bit relating to generating economic benefits. But on the alternative view around the scope, the view considers that if you look at other tangible assets, like, for example, property, plant and equipment, inventories, and even intangible assets, the standard includes within the scope items that based on the specific use and characteristic of that asset. So the standard are developed to address the specific use and the characteristics of that standard, for example, property, plant and equipment. This standard is a bit different because it is a residual value. If it's not within the scope of any of the other standards, it falls within the scope of this standard. And based on the scoping requirements, the IPSAS-B considered that tangible natural resources held for conservation are likely to be within the scope of the proposed IPSAS. So therefore, the alternative view is saying, as opposed to the standard being a residual standard, the standard should rather focus on providing guidance based on the use and the characteristics of tangible natural resources held for conservation, and not be as explicit and as broad as it currently is. Just on the definition part. So as I've noted earlier, the definition, it's an item that is naturally occurring, embodies service potential, or has the capacity to generate economic benefits, or both. So in terms of the definition, based on the scoping requirements, that tangible natural resources held for conservation are kind of the only tangible natural resource that the IPSAS-B currently foresee to be accounted for in terms of the standard. The alternative view concludes that based on that, tangible natural resources held for conservation are held not to be sold or explored, pardon me. So the intention is not for, if you have a tangible natural resource held for conservation, the objective of that is to preserve it for future generations rather than to sell it. And because of that, requirements around generating economic benefits in the definition is not appropriate. And likewise, the measurement requirements that I have included now provides for both those tangible natural resources that has a service potential and has economic or are able to generate economic benefits. So the alternative view considers that that is inappropriate, and without knowing what other types of tangible natural resources might fall within the standard, it might be that there's inappropriate financial consequences when you apply the standard to something that you don't really know. Or when you account for a tangible natural resource held for conservation, the guidance around the financial capacity in terms of the measurement standard might then be inappropriate. Some of the other proposals that the tangible natural resource IPSAS is proposing is, first of all, if you have a look at the definition and the fact that tangible natural resources held for conservation can also meet the definition of a heritage asset. Now, in terms of the international guidance, they don't have a separate standard like we have for heritage assets, GRAP 103. What they have done is that they have included some guidance in the property, plant and equipment standard, IPSAS 45, to explain how you need to apply the principles in the property, plant and equipment standard in accounting for heritage assets. So now that it can meet the definition of a heritage asset, tangible natural resource held for conservation, but it can also fall within the scope of this standard, entities might be confused around which standard do I now need to consider and apply to account for a tangible natural resource that also meets the definition of a heritage asset. So in order to address that confusion, the explanation of what a heritage asset entails in terms of IPSAS 45 has been amended. And the standard is now clear that if you have a tangible natural resource that meets the definition of a heritage asset, you need to account for that in terms of the proposed IPSAS and not in terms of IPSAS 45. Around the depreciation is some of the other principles that I've also included on which they ask a specific matter for comment. So around that, the principle in the standard is that you need to assess whether the useful life of your tangible natural resource is indefinite or finite. And if it's finite, you need to determine the length of the useful life. The proposed IPSAS does include a rebuttable presumption that recognized tangible natural resources held for conservation, because of the purpose being that you want to preserve it indefinite for future generations, will have an indefinite useful life. And because the tangible natural resource has an indefinite useful life, you will not depreciate that tangible resource. So that is another area where the IPSAS B asks specific comment around the presumption that tangible natural resources that falls within the scope of this standard has an indefinite useful life. Then lastly, something that I want to focus on is around the exemptions from certain disclosures. So in terms of the proposed standard, the IPSAS proposes to exempt entities from providing certain disclosures to further reduce the endangerment of the specific natural resource. If you think about our circumstances locally, if you need to disclose information around rhinos, that may result in the further illegal poaching of the rhinos. And as a result, this exemption will help for the entity to not disclose specific information about that tangible natural resource in its financial statements. The comment period for ED 202 is closing on the 14th of February. We have still one or two engagements that we are planning. In addition to this, to the standard, sorry, I just saw something on the chat. In addition to the roundtable with the IPSAS B representatives that we are planning for next week, Thursday. So with that, I'm going to hand over to Nabila to take us through ED 213, the proposed sustainability standard on climate-related disclosures. Thanks, Nabila.
Thanks, Amanda. Okay, members, I would just like to raise awareness on ED 213. This is the IPSAS-B's Sustainability Reporting Standard on Climate-Related Disclosures. Okay, so we know that the IPSAS-B is an independent standard-setting body that develops international financial reporting standards for public sector entities. Now, this ED is the first of the IPSAS-B's sustainability reporting standards for public sector entities. This is in response to the 2022 World Bank report calling on the IPSAS-B to develop a framework for public sustainability reporting, which was confirmed by respondents to the IPSAS-B's consultation paper on advancing public sector sustainability reporting. Now, respondents to the consultation paper agreed that there is a need for public sector guidance, but they noted that it was important to align with private sector standards, which already has developed strong principles. However, respondents also highlighted the gaps that private sector guidance does not address. The current private sector standards do not fully address public sector user needs, particularly because the public sector's role emphasizes service delivery as opposed to profit motive, and the public sector has a unique dual role through its ability to influence decisions or behaviors of other entities and individuals through exercising its sovereign powers, such as the ability to tax, subsidize, and regulate. Therefore, the IPSAS-B decided to leverage private sector standards to the extent appropriate, drawing from the ISSB's global baseline, primarily from IFRS S2, that's the IFRS Sustainability Reporting Standard on Climate-Related Disclosures, while incorporating the multi-stakeholder approach from the GRI standards and adapting these private sector guidance to ensure that the IPSAS-B sustainability reporting suite of standards addresses the core responsibilities of the public sector effectively. Sorry, I just want to go back. I skipped a slide. Right, so to address the public sector's dual role, the IPSAS-B considered the multifaceted nature of the public sector and the fundamental role that governments play in climate action. To start, the IPSAS-B recognized the existing international agreements and national commitments that governments around the world have already made. These international climate agreements, the latest ones being the UN Sustainable Development Goals and the Paris Agreement, underlie and set the background for the understanding of an entity's context. These agreements represent a collective commitment on climate action of governments, but also extend to the entire economy. Therefore, the IPSAS-B identified two perspectives on how public sector entities interact with climate-related issues for which the ED proposes to provide disclosures on. On the slide on the left, disclosures about an entity's day-to-day activities, which the ED refers to as own operations. Here, public sector entities alone have a significant economic, environmental, and social impact. The IPSAS-B noted that government contributes over 40% of global GDP, and they employ more than 20% of total employment. These disclosures would address those day-to-day activities of public sector entities, such as public sector activities to run schools, hospitals, or other services. On the right, we see disclosure on public policy programs. These are to address the public sector's unique tools and levers to influence entities and individuals, which proposes that entities provide public sector specific disclosures that covers their policy responsibilities. The IPSAS-B decided that specific disclosure requirements and guidance were necessary Firstly, because the public sector has the unique ability to set policies and regulations which impact the economy, environment, and people. Secondly, this role was specifically highlighted by responses to the consultation paper. And lastly, this role is not covered by private sector guidance. A quick overview on the proposed disclosures. Now, for own operations, the ED proposes an entity provide disclosures about the climate-related risks and opportunities that could affect the entity's day-to-day activities. And this is expected to be applicable for all public sector entities and their various delivery activities, such as the running of schools and hospitals. These proposals are aligned with the Task Force for Climate-Related Financial Disclosures, for short the TCFD, and IFRS S2, as the IPSASB decided that alignment with IFRS S2 meets the information needs of primary users of public sector general purpose financial reports, and it supports consistency between public and private sector reporting, which is important to support investment from capital markets. But the ED does include adaptations for the public sector, such as the focus on providing information on the climate-related risks and opportunities to an entity's long-term fiscal sustainability, which includes the entity's continued ability to fulfill its objectives, including meeting its service commitments. Now, turning to the public sector's public policy role. Here, the ED proposes disclosures about climate-related public policy programs and their objectives. This includes any public policy programs, could be law, regulation, taxes, or subsidies, with a primary objective to achieve climate-related outcomes. They refer to this as climate-related public policy programs. These additional disclosures are required only for select entities who are responsible for the outcomes of a public policy program that are accountable for the success and outcomes for those programs. If we look at an example, I'm looking at the Department of Transport that designs and develops electric vehicle subsidy program with a primary objective to encourage the transition to low carbon technology and reduction in greenhouse gas emissions. This would be an example of an entity who would have to provide these disclosures about its subsidy program and its outcomes under public policy programs. Okay, so that was a very high-level overview of the IPSASB's first sustainability reporting standard. I just want to cover next steps for ED 212 that Amanda discussed with you and ED 213. Both exposure drafts have a local comment deadline on the 14th of February. If you would like to hear more about these exposure drafts, we do have a round table for PSEF members that you may join on the 11th of February. There is also a hybrid IPSASB event on the 13th. I think if you would like to attend these sessions, if you haven't joined any yet, then please drop your email address in the chat and we can forward you the invites or details to register for the hybrid IPSASB event. Also to note that our invitation to comment and all other material, including the EDs, are available on the ASB website. Your input will be considered in our comment letter to the IPSASB, and after the comment period, all comments will be considered by the IPSASB when developing their final standard. With this, we end off on our EDs out for comment. I would like to pause here, take any questions, or hand over to Elisna. Thank you. I do see an email address. We will forward you details. We have a question. How is the material shift on climate change policy direction by the superpower the USA have an impact on this ED 213? I don't think with respect to this ED, any political direction, or, well, the USA could maybe have too much of an impact. This deals with sustainability reporting. I guess there are other climate agreements like the Paris Agreement. There's also the UN Sustainable Development Goals. So if there maybe is an impact, I think it'll be on a very high level. But with this particular ED and with respect to reporting, I don't think there's going to be too much effect on, I guess, what your comment relates to. Thank you. I do see a whole lot of email addresses. We will be in touch. Thanks, Elizna. Over to you.
Thank you, Nabila. Yes, I think the world is trembling after Trump, but let's see what happens. Okay, so I'm just very briefly going to talk to you about a few of the projects that we have ongoing and guidance that we have issued recently. We are now onto the lighter side of the agenda, and I think we should be able to wrap up in time. So I'll just start by giving you some feedback on our post-implementation review on principal agent arrangements. We heard a lot from you, and our board assessed all of the feedback we got and published a review report that is available on our website. The next steps that we are going to undertake is included in the review report. We are busy with all of those. We are busy developing guidance as the staff, and we are developing a proposed exposure draft to change the requirements in GRAP 109. I should say that we are not proposing to change anything in substance. The principles will work in the same way, but I think what we heard from the review was very clearly that there's a lot of misunderstanding and uncertainty, and we'll see what guidance we can add to help with bringing common understanding in the environment. So when is an arrangement a principal agent arrangement is really what we need to help with. Then another project on social benefits. We spoke about this very briefly earlier on when I chatted to you about the work program, and that this is the last part that we are doing to fill the gap in literature. And we will be establishing a reference group for this after the board approves the standard. So where we are at now is the board will approve that final standard in March, hopefully. And we will then commence to develop transitional provisions and work on what the effective date needs to be. There will be some consultation with you again on that. I'm not going to talk too much more about the specifics of that standard because it does have very limited application, only really a handful of entities. So I think our concern may be more in the area when this is implemented, that entities who should not be applying the standard may want to apply it. So I think maybe with that being said, check with those who support you, the Treasury, us, your auditors, before you just apply the standard. I think if you should be applying it, you would know by now about this. If you don't know about it, it probably means that you should not be applying it. Then on related parties, I think Sia alerted to this earlier on when she spoke to you about accounting policies and quality financials. We have done a desktop review of related parties, and we heard that knowing when a transaction or a relationship is a related party relationship, and then if it is, knowing when to disclose information about the transactions with those parties, that could be difficult, and we are working on some guidance there. So Sia mentioned some FAQs. We have also a review report on our website. The review report touches on the key issues we heard, as well as all the next steps that we are going to undertake, and also gives a bit of guidance that will help in the meantime with reference to the current requirements in GRAP 20. Then the last project that I quickly want to talk about is measurement. So we do often hear from our stakeholders that they have difficulty in measuring assets and liabilities. And I think even today, some of the questions have touched on that. when to measure certain things at cost and what that means versus current value and what that means, and impairment. So we are developing a standard of GRAP on measurement. We did do this as an international alignment project, and the first phase was to understand what guidance do we have internationally that we could use? What would that look like in our environment? Would it solve the issues that we have? So we definitely heard a lot of yeses there to say international guidance will help us locally. So we will be developing a standard of GRAP on measurement, and alongside that, changes to our framework, the chapter on measurement. The exposure drafts on those two pronouncements, the framework and the measurement standard, will come out towards the end of this year, so you can have a look out for those. Then just before I hand over to Amanda for the last part of today, I want to mention that on our website, you can find a whole lot of resources. We have fact sheets, we have the FAQs, we have communiques about new standards of GRAP. So please take your time, browse around our website if you're not already familiar with that. We do have a recording on YouTube that helps you to navigate our website. So if you don't know where to start and what the website looks like or where to look, please just watch that recording and it will show you and navigate the website for you so that you can know where to get what we have. Thank you. With that, then I'm going to hand over to Amanda for the last part of the presentation. Thank you so much for all the email addresses. I think Nabila and Sia will have to spend some time collating all of those, and we will make sure to invite all of you.
Thanks, Elisa. So the last part of the discussion today is really around enhancing the application of the standards of GRAP. So this is a project that the board has specifically included to assist entities with the implementation of the standards. What it really involves is content that is added in the form of YouTube presentations, and the Secretariat is responsible for this by making it available on a quarterly basis. It includes subjects on assets and how we use the financial statements. The focus next year will be not only to provide guidance to the preparers, but also a bigger focus on also providing guidance to the users of the financial statements. So I'm just quickly going to touch on the topics that we have included. This project is coming from last year as well. So in addition to the YouTube content that I'm going to touch on today and just highlight to you what the content is about, there's also a similar project for last year. So there's more YouTube information available on topical areas. So the first one really is around the reporting framework for 2023-2024 onwards. So this is the content that we have published last year in June 2024. So at that point in time, the reporting framework that entities had to consider was quite important. So it just provides an overview of Directive 5 and the reporting framework annexure within the directive to inform entities about what they should consider when they prepare their financial statements for the year ending 2024. The next one was on GRAP 25, the key issues from the employee standard benefit that the board, that the Secretariat has developed. Really just a snapshot of the changes on employee benefits that entities need to consider when they prepare their financial statements. The next one was on the amendments to GRAP 105 and 107 that I've talked to you about earlier on today. Again, it is just a snapshot and executive summary of the changes that are proposed to 105 and 107. Even though it's not yet effective, I think it's still important for entities to be aware of these changes. The next one is around what was on the ASB's work program for 2024 and 2025. We've also touched on that as part of our discussions this morning. But at that point in time, June last year, that was what we wanted to inform the stakeholders about, what they can foresee from the ASB's perspective. Then there was also a presentation on materiality, the basic principles, really informing you who needs to assess materiality, when do you need to consider that, and what are some of the other factors that we need to consider. I think Tia has also touched on that as part of her presentation today. Then we have, as part of the June content that we have published, accounting for naturally occurring non-purchased water. And that was specifically the focus of frequently asked question 3.3 that we have explained to you in a bit more detail. And then a general one, I think that is still relevant around how to use the ASB's website. So that one was also published in June to just inform you where you can find the various pronouncements that we refer to from time to time. The focus for the content that was issued in the, September last year was really around the basic principles from GRAP 1 on the presentation of financial statements and the conceptual framework. So the first content that we've published here was around the accrual accounting. Why is it important and what are the benefits when you prepare your financial statements on an accrual accounting basis as opposed to a cash basis of accounting? Then we also talked about the going concern, which we also discussed a bit earlier on this morning. What does going concern mean and what should entities disclose in terms of the revisions to GRAP 1 concerning the going concern? Then there was also an important one that we've published around the importance of disclosing information on significant judgments and uncertainties. So why is it important for you to disclose information around your significant judgments as part of your financial statements? The next area as part of the September content that we've issued is really for you to understand what is the difference between consistency from one period to the next versus comparability when you compare your financial statements with other entities. What are the difference and what are the main considerations around comparability versus consistency in preparing financial statements? Economic substance versus the legal form. So when you prepare your financial statements, we always say you need to consider substance over form. So this YouTube presentation really informs you what does it mean to consider substance over form. The next one was around current and non-current assets and liabilities. So when will something fall within the ambit of a current asset and when or liability, and when will something fall in the ambit of a non-current asset or liability? And what are the order of liquidity that you need to consider when you prepare your financial statements? The last one in this quarter that we've dealt with is to explain whether entities may provide information in their financial statements that is not required by the standards of GRAP. So are you able to provide information in addition to that required by the standards of GRAP to inform your users or that can be useful to the users of the financial statements? The theme for the quarter ending December 2024 that we have published was more to focus on some of the existing frequently asked questions, where we get a number of questions, even though there is already a frequently asked question dealing with a specific topic. So for this period, we have considered, first of all, frequently asked question 7.12 that deals with the interaction between GRAP 11 on construction contracts, the housing guideline, and GRAP 23 on revenue from non-exchange transactions and transfers. So this recording will really provide you information to say that if you receive a grant for participating in a housing arrangement, how do you need to account for that grant funding that you have received? The next frequently asked question, the focus was on question 7.4 that deals with assessing if an arrangement is a service concession arrangement, a joint venture, or a principal agent arrangement. And 7.12, the interaction of GRAP, where there are two or more standards that requires similar information to be disclosed. The next question was on frequently asked question 1.1 and 1.2 to really explain what is the role of the conceptual framework and when will preparers consider the conceptual framework when they prepare their financial statements. The last topic for the December content that was issued was the difference between the public and the private sector and how are they considered in developing and what considerations does the Secretariat and the board consider when we develop public sector accounting standards. The last content last set of content that we are going to publish towards the end of March that you can look out for is, first of all, how to develop appropriate accounting policies and what information do you need to disclose in order to ensure the quality of your financial statements. So again, we touched on some of the requirements around improving the quality of the financial statements. So this YouTube recording will touch on some of the principles around developing appropriate accounting policies. The next one is on GRAP 24, the presentation of budget information in the financial statements, and really communicating the key messages from the desktop review that the board has undertaken from the review report and the information that is currently contained in the fact sheet that is dealing with GRAP 24. The second last one is the difference between a condition and a restriction in terms of GRAP 23, and when do you need to account for which one, when will something be considered a condition and when will something be considered a restriction? So when do you recognize the revenue, or when do you recognize the liability and reduce the liability for the revenue recognition as and when the conditions are met? I've missed the one in the middle. How should the cash flow statement be prepared and presented? This is again the messages that we received from the review, the desktop review that we've done on the cash flow statement. So the information from the review report and what entities need to look out for when they prepare and present their cash flow statement. The last one for this period is around certain thresholds. The standards of GRAP sometimes refer to significant, sometimes to substantial, sometimes to probable. And this YouTube recording will then just explain to you what exactly those terms means in terms of looking at from the financial statement perspective. So this is really in short what we have done around the enhancing project. Like I've indicated, we are working on a plan based on the work plan consultation, but the focus going forward will be to focus on both the users and the preparers for us to assist you with understanding the financial statements and really getting into the understanding of the principles within those standards. So with that, just the last slide to show you where you can find the information on our YouTube channel and the various links that we've included in there. So with that, Elisna, I'm going to hand it over to you to just take us lastly through the stay informed guidance and thank the participants for their inputs today. Thank you very much, Elisna.
Thank you. Thanks to all three of the ladies who did the presentations to you today. It's not easy to come and stand here before you and present to you, and I appreciate your time. We just very lastly want to share with you how you can stay up to date with all of our activities. Today was an information dump, I would say, because there's so much that we want to share with you. And a lot of it we do communicate to our stakeholders on an ongoing basis. So if you follow our website, you follow us on our social media platforms, and you subscribe to our newsletter, you will probably receive all of the communication that we've shared with you today on an ongoing basis, and that will just help you to keep up to date. Our website is certainly our central platform, and where you will be able to access everything that's on the slide and everything that we've spoken to you about today. I think in closing, I would just like to extend a very big and warm thank you to all of you who joined us today. So I thank the ladies for preparing, but I think we would not have had the opportunity to prepare if it was not for you and your attendance today. You are, of course, our important stakeholders, and we would like to see you more involved in our processes. And if there's anything that we can assist with, here is our email address where you can contact us. I think just in closing, we did mention that the recording will be available on our YouTube channel next week, so please look out for that. And then, of course, there were many things today that we shared with each other and said that we will follow up on. And we look forward to seeing you at our engagements next week, those of you that are able to join us for that. Thanks for all those emails. So with that, we are going to end the session and we wish you a wonderful weekend. All the best for your year end and preparing your financial statements this year. You will be in our thoughts and we would look out for more requests from you on guidance. Thank you. Have a wonderful weekend.
Thank
Thanks,
you.
everyone. Bye-bye.
Goodbye.
Thanks, everyone. Bye.